Well, welcome everyone to the last day of the Wharton Macrofinance Society Summer School, virtual summer school, first ever summer school for the MFS, first ever virtual summer school, perhaps not just for the MFS. And thanks to all of you who's been with us this week and for tuning in today. Today we have our last presenter, Lars Lochstoer, who's going to talk to us about model learning and expectations, implications for macro finance. Again, the ground rules as always, please put in your questions in the chat box and Lars will take them as he goes. Thanks again for being here. And Lars, thank you for doing this. And the virtual scene is yours.
All right. Thank you very much for having me, and thanks for coming. I hope some of you also enjoyed the virtual finance workshop this morning and are excited to do 3 more hours of finance and macro finance. So I will also, if you raise your hand, I'll take some questions live too if you want to. What I'm going to talk about today is model learning, or sort of thinking about parameter model learning in macro finance, as well as some behavioral factors. There is, if you think about sort of the last decade in macro finance, there's sort of a lot of new areas coming up. Literature on intermediaries is a classic to remember here. Institutional investors and their constraints is something Koya and Yogo, have talked about. And sort of there's a string of new behavioral that is taking surveys more seriously and estimating sort of non-rational beliefs. We can ask a question, which is, when I went to grad school too many years ago, these weren't the models we learned. We learned sort of the standard consumption-based models, and those are kind of a backbone of macro finance. And we can ask a question, which is why we depart from those models. At some level, if you think about Camel Cochran, Bansal-Yaron, and Wachter's model, they can't explain a lot of stylized facts, and they're pretty successful in terms of the aggregate moments, at least to some extent. And so I want to just highlight one thing I think is true, that a lot of people have gravitated away from those models, because when we look at the model sort of unconditionally, they sort of can match a lot of moments, but the conditional pricing is really not always there. So I'll give an example, which is, if you think about the cross section, a lot of times these models really can't account for, average premium to sort of other factors, so momentum or carry or value or what have you. And that's really a conditional failure, because that means that they can't conditionally get the risk premium on the cross section of assets right. Also in the time series, these models sometimes have a hard time. If you have the right model, then, when the model says that the price of risk should be high or a conditional risk premium should be high, is that at the same time as when they're high in the data? So that's a powerful identification tool. And so, a classic consumption-based model might say the risk premium should be high when consumption volatility is high, or when there's a great big crisis or something. But that might not be the case. And so, for instance, Muir argues that, in his QJE paper, argues that, wars and deep recessions, they're associated with really bad consumption events. But the risk premia, as they're measured in his paper, they don't go up as much as they do in financial crisis. And financial crises are also bad, but the consumption doesn't drop as much in those crises. So there seems sort of a scope for thinking about, if you're getting sort of the risk premium dynamics right at the right time. So I'm going to talk about is beliefs, okay? Now, and the dynamic evolution of beliefs. And so if you're thinking about, risk premium, these type of things, clearly investors have to form expectations in the right way. And those form over time in response to shocks. And so the question is, do they get it right? And what might they look like? Certainly beliefs is all about conditional risk premium and Sharpe ratios. And so what I want to talk about today is sort of rational benchmark, rational learning or Bayesian learning, and a non-rational. And so in the rational benchmark, like I said, if you're a rational agent, you would use Bayes' rule. We have sort of 2 ways of thinking about that. One is the one way we've been thinking about it for a long time, which is the standard models, which is full information rational expectations, okay? And in those models, beliefs are formed from shocks to state variables, and agents are updating, et cetera, but they didn't know the data generating process. At some level, it's a very easy problem for the agents. They know the parameter, they know the right model of the world. And so by doing that, they get to the conditional distributions. Another rational benchmark is also rational, is a limited information Bayesian learning type setting where, you are rational, you're using Bayes' rule, you're using all the information you have, but you don't know the model of the world, right? You don't know the parameters governing the data generating process. You might not even know the exact model specification, or you have multiple model specifications that you're thinking about. And so I'm going to argue that actually gives rise to really kind of big differences in risk and return across time relative to sort of standard ways of doing it. So that's one thing I'm going to talk about. The other thing I'm going to talk about is in the second half is kind of non-rational. There's a recent literature that takes surveys based evidence sort of more seriously, and I think that's interesting. You might think that that's not all agents, but at least some agents might look like this. And I think my reading of this is that there's some over extrapolation at the individual level, and then once you look at everybody across agents, there's some stickiness in their beliefs. So there's this joint thing. So I'll talk about these things. And since this is macro finance, and this is kind of what I've been working on, I'm going to think about embedding these type of beliefs into general equilibrium models. Okay. So how do you price updates in beliefs? What are the effects in general equilibrium? So that's kind of my focus. Here's an outline, what I want to talk about. I would love for you guys to raise your hands, ask questions. You can do it in chat, whatever. I'm going to start just a quick step back. I know most of you will know the classic stylized facts and models, but I'm going to spend 2 minutes talking about them. Then I'm going to talk about rational parameter and model learning. What is it bias? How does it work? What are the conditional implications? Might it help us understand something we see in the data? And I'm going to talk about how standard econometrics go wrong. If you don't know the model of the world, the standard kind of econometrics we have, where sort of sample averages are very close to sort of the true average, can have some issues. And so I'll show you that in context of sort of cash flow and discount rate decomposition, that you can completely flip the implications. And I think that's kind of an interesting thing to think about. Then in the second half, we'll talk about sort of some recent papers on belief updating from surveys, and then I'll talk about how those are embedded in sort of learning from experience and thinking about aggregate stickiness and individual over extrapolation, and thinking about how that might work in an equilibrium macro finance model, and how the conditional risk return trade-off might be affected. So a lot of this I'm going to talk about today is kind of since it's somewhat non-standard, I'll talk through the mechanics. How does it work? What can it get us? In the end, I'll try to spend quite a bit of time, like, at least sort of half an hour thinking about, how can we apply this in other settings? I'm going to show you a lot that's in the standard macro finance consumption-based setting. But really this can be extended, and I'm going to make some arguments that I think, the world is kind of changing. There are new regimes happening all the time, and we're kind of always in this model learning mode. And so I think that could be applied to a number of phenomena that I'm going to talk about at the end, okay? So this is all to have you guys stick around for a long time. All right, so that's where I'm going. I'm going to start just reminding you all of sort of classic stylized facts in macrofinance. And just to set the stage, I know most of you know this, but and you can take a look at Cochrane's presidential address. There's a lot of this there. But just so you know and remember, the problem we have, the fundamental problem we had sort of early on is that consumption growth is not very volatile. It's sort of 1 to 2% per year, maybe, depending on sample. And so there's not a lot of macro risks from that perspective. And maybe you'll say, oh, there's more now after the crisis, et cetera. Okay, we'll talk about that. But it's not a lot of consumption risk, obviously. Okay, so it must be a little bit more subtle. The other thing is number 5 here, I'll go straight to, which is stock returns aren't very strongly correlated with consumption contemporaneously. So, those are issues for the risk premium. We know risk premiums are high and strongly time varying, okay? Cochrane and Campbell tell us that price dividend ratio, if you look at the prices, the aggregate market prices, those prices are mainly driven by discount rate movements, they argue. Okay, that's a classic view. And we have that the risk-free rate is low, and we have lots of factors other than the market that command risk premiums, okay? So these are kind of this classic stylized fact that everyone sort of had in mind. The original consumption-based model just says that the risk premium of any asset should be sort of risk aversion times the covariance of the asset with consumption growth, okay? And that model is just not, that I think there's broad agreement that model really doesn't work. These covariances are low because of low correlation and low volatility. So you need really high risk aversion. And to get risk premium to move around a lot, you might need something like time varying risk aversion. Okay? So the main models people have looked at and are kind of our benchmark models, I think now, is fair to say, is Campbell and Cochrane, Bansal-Yaron, and I would add Wachter and Barrow also to that. The solutions in these models are basically, they're different channels. These are the main channels. I'll talk about these in the context of some of what I'm doing. So just to refresh your memory, Campbell and Cochrane kind of solves some of the issues here with effectively high-end time varying risk aversion through habits. Okay, and Bansal-Yaron, on the other hand, says that yes, there's not a lot of short-run consumption volatility. But there's a lot of long-run risk, okay? So you really don't know where the economy is going over the long run, and stocks are correlated with that part, not the short run, and that gives us a lot of risk. And now, if you're averse to this long-run risk, which means Epstein's preferences, with a preference for early resolution of uncertainty, you get high risk premium. And finally, we have sort of the disaster literature. So I'll talk about Wachter because there's some of the original work, Reitz and Barrow, has sort of this constant disasters. What Wachter have is the time varying probability of a disaster. So disasters are like very big consumption drops, right, that generate risk premia. If the probability of that is moving around, well, you get time varying risk premium. So generally, I would say these models are very successful in many ways, okay? They all have some issues. There's some debate about whether this cash flow predictability in Bansal-Yaron is too much. Does Wachter have a hard time with the real term structure? And Campbell and Cochrane has very high correlation between returns and consumption. But sort of by and large, they can account for a lot of facts. But it's when we look at the conditional stuff they really start failing. Okay, so I'm going to talk about how this assumption might change some of that. So all models assume investors know the model of the world, including all of these models, including all parameters and distributions. Okay, and I really think if you loosen that a little bit, we get really a lot of exciting new implications. So before I get to all of this kind of stuff, and like I said, I think these ideas that I'm going to talk about can be applied in other settings. I want to give you a really cool example from the real world. From the oil market, okay? So this has nothing to do with those models particularly. It has something to do with learning about the model. So the oil market, here's the US oil market, and these are the US futures curves. And so what you see on this plot is the futures curves from 1990 to 2003, okay? And on the left-hand side, you see the maturity. You see the left-hand side is kind of the spot price, so the next to maturity futures. And what you see is that it seems like in this period, the spot price was moving between sort of 10 and 40, or a little bit less than that, maybe 12 and 37, all right? When you go to the long end, what you see is that there's this mean reversion, right? Everything kind of comes in. It seems like the long end is very anchored. It seems like when investors are pricing these contracts, they have in mind sort of a long-run price that's very well anchored. It's not really a function of the spot price. It sort of always comes back to someone around $20 per barrel, okay? So that seems to be a very nice stationary environment, mean reverting. Everyone seems to be pretty much in agreement. Okay, what happened in after 2003, from 2003 to 2008 here? Well, so just in terms of history, what happened was that China joined the World Trade Organization in 2001. They had a really strong growth. They kept having very strong growth, and their demand, a lot of demand from East Asia in general, but China is particularly, created, very high commodity prices, okay? And so what you see here as this dashed line is the commodity price, the oil price, and the futures curve. So first off, in the maturity from 6 to almost 10 years here, So first off, you see that there's a total regime shift here in the level of the prices. This gray area on the bottom, that's the same plot as here. Okay, I just changed. That's literally the historical prices. That's the same over here. You see the new prices are just totally dislodged. Okay, so that's one thing. The other thing that's happening is look at the long end. The long end is totally unmoored. You know, it's not anchored anymore to this long run price. So to me, this is just a very strong example of a case where there's maybe a new regime that we really don't know. We don't know what the long run mean is. You see that this long run, this is flat. We don't know what the long run mean is. We might not know how persistent it is. It looks incredibly persistent. Like it really just looks like a flat line. Okay, so I'm going to argue that this is some of the things we will see if you're thinking about learning about the model. You will see this thing that in the long run, the expectations kind of move a lot and are very much related to what you're learning in the short run. Okay. If this had been like just a known regime, everyone was happy, then you would think that there's a new regime where the price is 100. You would think that these things would sort of mean revert back to 100, and investors knew that. But the fact that they're moving all over the place, I think it's pretty strong evidence that they did not know, the long run mean of this new world they found themselves in. All right, so the question is, when you're faced with a new environment or persistent or hard to learn components in a quote unquote small sample, how do you form beliefs? Okay, I say small sample here because you could imagine that if you had 1,000 years of data, this would just be one of the regimes you really understood, but we don't have 1,000 years of data, and so how do we form beliefs in real time? So 2 questions here: what is the rational benchmark? And the second one is, what do at least some investors do in terms of updating? And I think there's lots to do here also in the interaction. Okay, so for the first hour, and again, ask questions if you want. For the first hour, I'll talk about rational parameter and model learning. Okay, it's a benchmark. I'm not saying necessarily everyone is rational, but it is. We typically have some rational people in the model, and this is what they'll do. So I'm going to go kind of slow here. For the basics, just because I know some of you are not familiar with it. The big insight is this first equation. Okay, so think about, so theta is a parameter, so some unknown parameter. It's not a parameter we know here. Okay, it's an unknown. We have to learn about it. Now, if you take a conditional expectation of this parameter, which is a constant in reality, we just don't know what it is. You see that. If you're thinking about your expectation today about where it's going to be in the future, okay, it's the same. So you're going to think if you're going to project where this parameter is j periods from now, you're going to put the same number up as you have today. Meaning beliefs about parameters or models or fixed quantities are martingales. Okay, so I'll show you this in a number of different settings. But what that means is that every time you update your belief about the parameter, that expectation is going to last from here to infinity, all right? And that's kind of what you saw in this oil market, arguably. If you're updating about, sorry, I'm just flipping here. If you're updating about the level of the price, well, that expectation is going to carry through till the very end because you don't know what the true mean is, for instance, in this new regime, okay? So shocks to beliefs are permanent, and I'll do this many times, and that's going to give us a lot of action, okay, for long-lived assets and for utility, because if you're a long-lived investor, you care about consumption not only tomorrow but also in the distant future. So I'm going to start as simple as possible to build up understanding. The simplest cases are not the empirically most interesting, so we have to do a little bit more heavy lifting to get sort of exciting stuff and realistic stuff. But the simplest cases are where we can really understand what's going on. So I'm going to think about a very simple model where you think of this as dividend growth. It could be consumption growth. And truly, dividend growth is IID. And investors think it is IID as well. And they know sigma, they know the volatility, and they know that the shocks are normal. So I'm going to give these investors a lot of information, but they don't know what the mean is, okay? So they're going to have to learn about the mean. So I'll show you this problem, and I'll show you how this affects sort of expectations and the dynamics, which really this is all about. So what we're going to do is we're going to use Bayes' rule. Okay, we're going to have rational learning, and Bayes' rule has a sequential learning version, which if you let y to the super t be the history of observed data until time t, and theta be the parameter vector you're learning about. In our case, that's mu. The history is just the history of dividend growth, okay? Then you have this fact that your posterior at time t is proportional to your prior about the parameters at time t minus 1 times the likelihood function of the data, the observation at time t, given the parameter, okay? So this way you can sequentially learn. And so in our case, I'll just say it in words and I'll show you the formulas. In our case, if the prior is normal, okay, with some mean and some variance, this A is gonna tell you something about the variance of your beliefs, and mu is your current best guess, okay, mu sub 0 in this case, or sub t. That's normal, so that's a normal PDF. And then what's the likelihood given all the parameters, given mu of dividend growth? Well, that's also normal. So you multiply together two normals, you get a posterior here that's also normal. So that's kind of how, you know, this would work. But if you have different distributions, of course, we'll give different posterior distributions too. Okay, so now we can start figuring out what the posterior is. And in this case, because we have a nice problem, we have these conjugate priors where the sufficient statistics summarize the history. So I get time varying, you know, over time I get the beliefs about the mean UT and AT. Okay, so here's the baseline. It's a very simple example. If you solve that, you know, prior problem and you do the learning, you can derive what dividend growth looks like in agents' minds, okay, in their filtration. So it looks like this. Dividend growth has a time varying mean, which is your prior mean for what it is, plus a shock, and that shock is more volatile than a true shock. And the reason it's more volatile is because you're uncertain about the mean. So some uncertainty from that comes into here. And here's the martingale property I talked to you about. Your best guess of the mean at each point is a unit root. Okay, it's a unit root because it is the previous best guess plus a shock that you can predict. Now the variance does go down in this example, very simple, and it goes down. Your certainty your precision goes up, so the variance of beliefs go down, and in the end you will actually figure it out if you have an infinite set of data. But this is a very simple example. It's not the most empirically exciting because you do learn sort of relatively quickly. But if you just look at these equations, you see that this looks like long run risk. You know, it looks like the investors are faced with long run risks. And if you think about that, it's a growth rate of the economy. They don't know where it is. And every time they update it, it's a permanent update. So if you think about a long-lived asset like stocks, that's going to be a big impact, right? Okay. So in the end, we just know, we will learn. So one question I will talk about is, you know, how quickly. Another thing that's important to know is that if you're an econometrician that looks at a full sample, you would probably, you would estimate dividend growth to be IID. You couldn't predict it or anything like that over the full sample, but the agents don't perceive it in real time, right? So it's the long run risks the agents perceive are subjective. It's not like you can predict dividend. That's different from Bansal-Yaron, right? It's not like you actually can predict this. It's just that we don't know the true model. Okay, so that's one thing that I want to have in your back of your mind, that if I learn about any parameter, any change in that update in those beliefs are going to affect me from here to sort of infinity. The other thing I want to talk a little bit about is how parameter learning leads to some problems with standard econometrics. So this is a very simple example. This is actually from Timmerman, 1993. And he just points out, you know, think about investors as risk neutral. Log risk free rate is just constant and equal to R. They use a Campbell-Shiller approximation, so I hope you guys remember that, but that's just a log linear approximation for a price-dividend ratio. And S is a superscript for agents' subjective expectations. So agents in this economy, again, don't know the mean, right? So when they're calculating the price-dividend ratio, it's the future cash flows from here to infinity, just discounted slightly, the usual log organization discount, minus the expected return. Well, in agent's mind, the expected return is going to be the risk-free rate. So that's really easy. But what is the expected cash flow? Well, it's just going to be your current expectation discounted by rho each period until forever. Okay, so the price-dividend ratio is some constant. I skipped the constants here. your belief about the mean minus some other constant stuff. So the price dividend ratio is going to move around. And even though these movements are small, rho is close to 1, so it's going to have a big effect, right? And that's because it's a long-lived asset. So what you get is that price dividend ratios move around a bunch, right? Now, again, imagine you're an econometrician, you have a big long sample, you're not like the agent who has to go through the sample in real time. You're an econometrician, you try to predict dividend growth, you're not going to be able to because it's in over the full sample because it's truly IID. And so you will conclude that, you know, the dividends aren't predictable, but prices are moving around. I'm going to call that discount rate shocks. Okay. So I'm going to say that expected returns must have been moving around in the sample, and there must have been timing risk and risk aversion. So those two things that's sort of an important thing to think about. Okay. One, we have this permanent updates, so it's big effects on prices. Two, and potentially on an agent's utility. And two, there's a difference now between sort of ex post and ex ante, which is a little bit more binding than in standard models. Okay, so in this case, the econometrician would get it exactly wrong. They would say the reason the price dividend ratio is moving around is all discount rates, no cash flow risk. But in reality, the agents are experiencing the opposite. Okay.
Hey, Lars, can I ask you a question?
Yes, you may.
Ex post, when you run predictive regressions for returns.
Yes.
So you're going to find, I just want to make sure I'm following. You're going to find what? You
find that you can predict, and basically it's you know, you have the benefit of knowing the full sample average. Investors don't know that. So if the average up until some time of dividend growth is higher than the sample average, then prices will be higher, but they will come down mechanically. It's kind of like a Stambo bias.
But so if it turns out that the average dividend growth was pretty constant over the whole time period, which may be a kind of very simplistic way to summarize what happened, you'll find a lot of mean reversion in the price dividend ratio. But in principle, with the same setup, tell me if I'm wrong here, if you found that dividend growth started low and ended up high, not just for dumb luck's sake, then it wouldn't have to be the case.
That you get predictability?
Yeah.
I mean, I think you still would, because the price dividend ratio would start out low and then end up high, right? If it went up like this, and so returns and I mean, if it was totally smooth, you probably wouldn't get it. But if it was some variations, then returns would probably have been the highest early on. But it's possible to not get it. It's an empirical question whether you do get it or not. I'll tell you what I show in some work that you do get this. If you have some interesting learning problems in samples. I think the key thing here is the following. Out of sample, you should not be able to predict, right? If you run out of sample predictive regressions like Goyal and Welch, you will not be able to find return predictability.
Okay, so that's whether the particular kind you find in the full sample may depend on the path of path of realized dividend growth, but the out of sample is always going to be zero.
Always going to be zero. Yeah, and I think that's consistent with at least some of the results in the literature, that we have a really hard time predicting returns out of sample with sort of price dividend ratios, and a lot of these decomposition have been in sample. Okay, so that's the issue with learning here. You can get this difference between ex post and ex ante that are kind of a little bit more meaningful. So when you do the ex post, accounting of what is risk premium and what are growth expectations, you're kind of getting it wrong because you're over conditioning. You're using future information that the agents don't have. Okay. So I'm going to talk. So the first hour here, I'm just going to talk I'm going to start talking about pricing, and we're going to think about Epstein-Zinn preferences and how that would work. And the intuition is just really simple. I think if you work with Epstein-Zinn preferences, you know that what shows up in the pricing kernel is the continuation utility. So, that doesn't happen in power utility. In power utility is just consumption today and tomorrow, but in Epstein-Zinn, you have this extra term, which you also can think of as the return on total wealth. Now, if there are these persistent shocks that are happening when you're updating parameters, that wealth, that return on wealth, or that continuation utility will be very volatile, okay? And so that extra volatility is going to lead to more more risk. And the important thing, I think, is that with interesting learning problems, that degree of risk is really time varying in kind of interesting ways. So you get a lot of time varying risk because sometimes there's more uncertainty about the parameters and models than others, okay? And they're more risky. And so I'll talk about when that is and why that is. So what can we explain?
So Lars,
yeah.
Sorry again, I don't know how to do the hand thing. Do you then, you gave the stylized facts at the beginning, and one of them was that most of the variation is due to discount rate, which I think most people believe. So
yeah.
Given what you just said, do you believe that, or do you think the evidence is not conclusive?
No, I think the evidence is not conclusive. I think if you go through, so I have done kind of with Mike Johannes, and you can move out a paper in JF where we go a very complicated learning problem, and we get a lot more cash flow predictability in the price dividend ratio when you go through the sample sequentially and learn about parameters, and also we get a model that correlates with the price dividend ratio more than I think a lot of these other models do in the sample. So I think it's not entirely conclusive. I do think there's some. I don't think the amount of predictability is zero. I do think discount rates vary. I'm just saying this is an additional component. Okay. So what we can explain that the models without full information has a hard time with is as I said, in-sample predictability much higher than out-of-sample predictability, and that's something you would expect here. You get excess volatility without excess cash flow predictability. So one of the tensions with this long-run risk framework is that asset prices should really predict long-run macro outcomes. There's always this tight connect. Here the connect doesn't need to be that tight. Okay, you don't necessarily predict future macro outcomes. There's a lot of movement in prices that you can't expect, that you can't relate directly unless you take this learning view. Another thing I think is, if you hit states of the world where you're more uncertain, okay, you can get very high risk prices and very high return volatility. And so I'll show you that if you're sort of at the onset of a disaster state, in these models, you can get 80% return volatility simply because these are states of the world you're very uncertain. So you get high risk premia, high return volatility, that is pretty rapidly declining afterwards as you're learning about the environment you're in. But in order to get this type of return volatility, you really need those permanent shocks in these models. So I think that's relevant. I mean, we've seen that in the financial crisis. We've seen it with the COVID. Once the COVID thing hit, the VIX spiked at very high levels, and then it's come down quite a bit pretty rapidly. And so it's some of this disconnect or apparent disconnect between consumption and asset prices that I think this can help us understand. Okay, so let me show you within Epstein's framework, and then I'm going to go through some of this my models here. This is for the paper with Mike Johannes and Pierre Colin Dufresne. And the reason, again, is I want to show some mechanisms that happen. I don't think this is sort of well understood by the average, PhD student. And so I want to show, some of the mechanisms. What can we get from this? And I'm not saying that, you should be doing a consumption-based model and just add learning. In fact, I don't think that. I think there's lots of interesting things to look at when it comes to monetary policy and behavioral or institutional constraints, et cetera. What I am saying is that some of these effects that we're seeing here is likely to interact with those things. And so I think it's useful to sort of go through and show how it might work, okay? So I'm going to do for pricing, I'll show you this real quick. I'm going to do the same model. I'm going to call it consumption instead of dividends now. And I'm going to go to a consumption-based model, and it's not that exciting quantitatively. It's just to show you in the simplest possible way I can. How does this affect risk pricing? Well, same problem, same issue. You know the sigma, you know the epsilon. I'm not saying that's particularly reasonable either. I'm just making it simpler. You just don't know mu, okay? Same updating. As you go through the sample, you're uncertain about this mean. The mean will move around. It doesn't have an autocorrelation coefficient on it like it does in Bansal-Yaron. It's a unit root because, as we've established, parameter beliefs are martingales. Okay, and you have this shock here, which is shock to belief, which is declining, but can be have a large effect. So I'll just remind you, if you have Epstein's utility, and I'm going to do the EIS equal to 1 just for this particular example because I can have analytical solutions. what you get is that the pricing kernel is sort of beta, and then there's an expectation component that I'll just call delta t. It's not important for my discussion here. And then I got risk aversion times consumption growth, like that's power utility, right? But then I have this added Epstein's term, which is the value function normalized by consumption in logs here, value function minus consumption. Or I could, with slightly different coefficients, I could have the return on wealth. So this is the additional thing that happens when risk aversion is not the inverse of the EIS, okay? So if you look at the normalized value function, you can in this model, you can solve it analytically, and we do that in this 2016 paper. And you know, the value function is the future consumption and then future value functions. You can see that the value functions are going to be effectively future expected consumption growth, highly nonlinear, but future expected consumption growth. So if I have shocks now, the future expected consumption growth, every period that's going to hit the value function. And you can show that shocks to the value function in the model can be written as the shock to the belief in mu times this multiplier. So what is this multiplier? Beta is your rate of time preference. That's a number like 0.994. It's like how much you discount tomorrow in next quarter, okay? So 1 minus beta is sort of the duration, okay? So this is the duration of a shock, because it's an infinite, it's a permanent shock, but you do discount the future a little bit, right? So this is the duration of the shock. So the magnitude by which this little shock here hits your value function has a multiplier that in this example is 167, okay? So it is sensitive to how you discount the future, but if you do care about the future, which a lot of the models have that we really do care about sort of longer periods, then these type of shocks, even though they're small, okay, are gonna have a big effect on utility, and that's gonna have a big effect on risk, okay? So that's the mechanism. And so I'm gonna go to learning problems that are much more complicated and don't admit analytical solutions here, because those are way more interesting. This is a little bit of a boring problem, you know. The risk, for instance, is deterministically decreasing, et cetera. Okay. Importantly, longer risks are endogenous to the learning problem, and they're subjective. They're not something that leads to excess predictability in the future. So I'll talk about 2 cases just to show you kind of the mechanism. Does this give you a negative real? Yeah, so that's a great, I think you mean real risk-free rates. I think is what you mean. I got it's a chat question here. Does this give you a negative real? I'm gonna say real risk-free rates, like for a long risk model. That's a great question. No, it does actually not give you as much negativity in the risk-free rates. And usually, as long risk give you negative real risk-free rates. And the reason is that because you're learning, you know, the precautionary saving term is actually going to go down in the future. So in the long run, in some of these models, there is, you know, it's pretty flat, basically. I don't show that in the slides. We have it in the paper. And for this example, the real term structure is effectively flat. So that's a great question, and that's something that the Bansal-Yaron model has problems with. Risk premia are for risky assets are positive, okay? So I'm going to talk about 2 sort of different types of learning that I think are interesting and can give rise to a lot of action. So one is learning about rare events. Now, I want you to think about this as the mechanism by which you're learning about some new regime or something you don't observe that much, okay? So I'm going to use rare events because it relates to these older papers, but you could see this being used in other settings. So if you look at this paper, so Baron, Nakamura, Steins, and Ursua has this paper where they sort of use all available consumption data for a large cross-section of countries. They do all the econometrics that you can sort of want people to do, and they estimate the probability of exiting in a world disaster as 13.5% per year. But the standard error is 2.5%. So there's quite a bit of uncertainty about the probability of, you know, the persistence of the bad state, basically. You know, how long are you going to stay in the bad state? So the 2 standard error bounds of the bad state duration is 4.5 to 9 years in the probability itself. Of course, it's random whether you exit, but just not knowing that probability gives you a lot of uncertainty here. And these estimates, you know, are the best we can do today. That's today for us looking back at the full history. And so if you were to start the history and think about how the world looked 100 years ago, it seems like the uncertainty for them must have been higher, right? They didn't have a lot of this data. And so I'm going to show you that this type of uncertainty has big effects, interesting conditional dynamics, and it doesn't die off very quickly. So these disasters happens basically I think it's one every 87 years or something is what they, but basically once a century. So you can tell, if something happens once a century-ish, then you don't learn it very quickly, right? So that's pretty intuitive. We're going to consider unbiased priors. This is related to some work in Cogley and Sargent that don't price it. They have biased priors and anticipated utility. So those are interesting papers. So the consumption dynamics are super simple. I'm going to let consumption be a two-state switching regime model. There's going to be a mean and the volatility in each state. So we're going to have a Great Depression state, which I'm going to calibrate to the Great Depression. So that's sort of minus 1.15% negative consumption per quarter through the Great Depression. And it's more volatile consumption in the Great Depression. And then in the good state, the mean and volatility, mean is positive, volatility is low, like in the data. So these parameters are going to be known. And the reason is we did a big exercise, and what we have found throughout a lot of these papers is that what really matters for risk pricing is persistence of bad states. Okay? So we're going to let the probabilities, disaster probabilities, be unknown. Okay, and the probability of being in a good state. So pi 1,1 is probability of being in a good state. I'm not going to know that one. Pi 2,2 is the probability of staying in the bad state. I'm not going to know that one. And so we have to learn these guys. Okay, and these are beta distributed priors. So that's standard. And so the way you learn these probabilities is very simple. I'm not going to give you the formulas. It's very simple. We have it in the paper, obviously. You just count. You just count how many periods you're in the state and when you exit, etc. So it's just a simple count. And it's a beta distributed thing. You're very likely to stay in the good state because this happens once a century. And this is the bad state. Again, they're just calibrated. The truth is calibrated here. And I'm going to make investors unbiased. They're not going to have a biased belief. They're just going to be uncertain about it. I'm going to let them learn. Okay, I'm going to show the prices. So, Idemar, you can talk too, man. You don't have to. So
I don't want to keep interrupting.
No. That's good.
I was just asking that. I'm just trying to think back, and so I like the learning version much better than just assuming this constant, disaster probability.
Yeah.
And then I'm thinking after the fact, given that the consumption series was quite smooth.
Yeah.
Wouldn't it look after the fact like, hey, we got really lucky. Like we kept thinking this could go off the rails, and it always just kind of turned out okay.
It just didn't. Yeah. No, absolutely.
And then exposed, it looks a bit like a peso problem because it's either we just happened to be really, really lucky, or it just didn't happen to us.
Yeah. No, that's exactly right. So through the sample, when things don't happen, you would start updating. You would start getting positively surprised, and since you're uncertain about the parameters, you would start updating in favor of a better world. Where these things are less likely. Okay. So that this, I'm not answering that right now, but in a different paper, we sort of do exactly this. We calibrate priors, and a very big learning problem at the beginning of sort of the century, and then we look at the post-war, and one of the things we find is exactly that people sort of updated positively. Recessions weren't as bad as we thought, and I think that's that. To me, I don't know about you. I think that rings true. That the world doesn't seem sort of as bad as maybe you would have thought. The financial crisis, et cetera, didn't lead to a Great Depression. We got out of it.
The other hand, so stock volatility, you could say, has gone down somewhat, but I still don't know if we're convinced that things are like great. And we've had two crises in 12 years, but in some sense, if you pushed it further and you said, we had a good run, but I'm not that convinced that anything is so great, then you maintain this very high level of uncertainty at all times, precisely because of this regime issue, that you're just afraid that you're not in a constant regime and it's forever refreshed.
Yeah, if you think you sort of constantly get bombarded with these structural breaks, then you would maintain high uncertainty. It does seem, I'll talk about this a little towards the end. It does seem like, if you look at valuation ratios and these type of things, they seem pretty high relative to historical data. So that is at least consistent with people feeling that the world is less risky somehow.
Just one more little thing. So even, the beginning date is itself somewhat arbitrary.
Yes.
The people that in 1900s, they didn't feel like they're at the beginning of the sample. They probably looked backwards and thought, well, it's gotten much better over the 1800s. We used to die at the age of 30. Now it's like 40. So
right.
just, in that sense, it's got to be refreshed because we've been around for more than 100 years. So.
I completely agree with you. I think, so by the way, I'm presenting these papers and these are sort of my papers and I know them best. They have many shortcomings. One of it is that we don't have this sort of refreshed, I'll talk this at the end, but I really think the world is kind of constantly changing a little bit, right? Mm-hmm. And so in different ways. And so that does engage these learning problems. And I think it has these two effects, that if you have this type of preferences, it could generate extra risks, and it could generate these things that look like predictability ex post, but they're just really not. And so I think a better model would be to really understand how to model a more kind of always evolving non-stationary type model and kind of related to actual events. So I completely agree with you. And these are the first stab models.
Sure.
This is I want to bring in this question here from Junyi Liao, which is basically related, which is, when modeling, how do we choose which parameters the agents are learning? Is it mu, or is it sigma, or is it other parameters, or more simultaneously? And more important, how do we justify it? So the good news is, that's a very good question. The good news is, what we did is we looked through all the parameters in these papers, okay? And we looked and asked the question, obviously we want to make the model somewhat parsimonious. So what really matters, right? What are the parameters that really matter? And what we found is that, the volatilities do not matter a lot. The means matter somewhat, but really what matters with these preferences, at least, is the persistence of bad states. They're also hard to learn. They're slow to learn, the persistence of states. So that's sort of something that, at least seems to us, is one of the most important things to think about. And how do you choose the set of models? How do you justify what you're doing? It's a great question. I don't really have a perfect answer for that. We do something that sort of seems to make sense as a first pass. Obviously, Lars Hansen and Tom Sargent has thought about ambiguity and this sort of, when there's some unspecified model misspecification. But I think, in reality, people are trying to learn the model, and they're trying to figure out what the model is. And so I think that these are great questions, and I encourage you to figure out a better answer, okay? So I just wanted to show you just real quick, this is sort of, if you knew the parameters, what's the risk premium in this model, right? This isn't a disaster model that's Barrow, with 30% drop or anything like that. So if you knew the parameters, the risk premium is 88 basis points, 0.88% per year. So that doesn't cut it, right? So the risk premium is more like 5 in logs here. It's log risk premium. If you have 100 years to learn about the state, you observed it once, the risk premium is 5.6. If you observe it sort of 200 years or 300 years, you see the risk premium is declining as you learn, but it really isn't declining that fast, So that's my point here, that certain things are very hard to learn and they take a long time to go away. So in those type of cases, is it really reasonable to just slap on, the model of the world? And to me, I think, and you make up your own mind, of course, I think we're basically ignoring some big risks when we tighten the model so much and say the agents know everything that's going on, and so these things I think can be very important. Okay, I want to just show. Sorry, I wanted to give you some. This is just Bayes rule stuff. Okay. If you're uncertain about the belief in a good state, how persistent is the good state? The probability of going from state 1 to state 1. If you know the probability, you'll just stick to it, right? But if you're uncertain, as long as you don't see a bad state, this is what Idemar said, as long as you don't see a bad state, you keep updating your mean belief up until the bad state hits, and then you immediately update downwards. It's a big shock. These are small shocks because you expect it to last, right? And update downwards. And then you don't learn anything about the good state when you're in the bad state, and then you start updating again. And so what I have here are bad states that last for 4 years, 1 quarter, or 12 years. So 4 years is sort of what you're expecting. So that's the blue line. So here's the mean belief of a bad state. Even when you're in the good state, you don't learn anything about the bad state, right? It's risky, though, to you, because when you hit the bad state, you will learn, and you might update adversely. So once you hit the bad state, immediately you start inferring that it's more, as it lasts, that it's more persistent than you thought, okay, until it ends. And in this case, it ended exactly in your expectation, so you snap back to the same probability, okay? If it lasts longer than you thought, of course, you keep updating that it's higher, and when it comes back, you don't come back to the same level. And if it lasts shorter, you update that the probability is lower, okay? So if you look at the log wealth consumption ratio, this is going to have permanent effects here, right? If you update that the probability was worse than you thought, then that's a very bad state of the world, and your wealth levels are permanently lower. If you update that the bad states aren't that bad, your wealth levels are going to be permanently higher, okay? So I would argue that we see some of these things in the sample, but that's kind of the dynamics. If you knew the parameters, a wealth consumption ratio would go down in the bad state, but it wouldn't, it would just revert back. There would be no drifts here, no permanent effects. Okay, so I was talking a lot about conditional dynamics, and I think it's interesting here, the conditional dynamics. You got way more risk. So when you're in right before the depression, when you're in the good state, you have a high risk premium, 4.6. It's not that high, but it's sort of high relative to the known parameter case. Once you hit the bad state, though, the risk premium jumps to 22% with a volatility of 81%. And the reason is that every period you're updating these parameters, and they have persistent effects. There's a lot of action, okay? And so that's what I mean by parameter learning being state dependent. If you hit certain states where parameters are more uncertain, then this might happen. Okay, so I think that's relevant. We have seen the VIX go really, really high, and it's very difficult in these models to generate sort of 80% return. So learning about transition probabilities, really parameters governing persistence has tremendous impact on asset prices. There's sort of a six-fold increase in risk premium, also a high long sample average price of risk and excess volatility. So this is sort of very powerful magnification mechanism of risk, but it's also time varying, which I think is the most interesting. And so in particular, in the bad state, the volatility goes to 80% and the risk premium over 20% in logs here at the onset. So that's really, really high. And the learning is very slow, and asset pricing effects are long lasting. So that's sort of the rare events. Let me talk about one more thing I want to talk about, which is in terms of this setting, and then I'll sort of finish up the rational learning. There's also this idea that, if you think about learning about persistence as being important, there's been this debate in the literature, right, where Bansal-Yaron came and said, oh, you have long-run risks. So consumption dynamics has some sort of persistent XT process in it, where this XT is an AR1 where the autocorrelation coefficient is pretty high, okay? So there's a persistent component. And there's this argument that it's really hard to tell these two apart, the IID versus the persistence. And so I want to show you the mechanism when it comes to model learning. And I think this can be used in sort of very often when you talk to people in academia, but also in industry. They kind of have these different stories that they tell, maybe this scenario or this scenario, right? And so you can think of scenarios as being sort of different models, and you're trying to figure out which one it is. And if you're doing that, then you might wonder which is the true. And so I'm gonna define this M. I'm gonna solve a new model here and show you that gives you a lot of interesting stuff. If this M is an indicator for truth, okay, so in truth is going to be 0. In truth, the world is going to be IID, okay. But the agents are entertaining a possibility that it is. They don't know M, right? They don't know it's supposed to be 0. So they're entertaining a possibility that the Bansal-Yaron model is the right one. Okay. So what I'll show you here, why I'm doing this, I'll show you something. Well, look at this model. We have IID versus homoscedastic Bansal-Yaron. Okay. So both of these models have really boring conditional risk premium dynamics. Everything is constant in both models. But what I'll show you is that as you vacillate between the models, risk premium, you're in your beliefs, risk premium are varying a lot. And they're varying outside the bounds, right? So if you have the risk premium of Bansal-Yaron here, risk premium of IID here, the actual risk premium in learning can go above and below, right? So that's going to, get a lot of exciting dynamics. So I'll just give you a sense of how that works. I want to point out that this is model learning. Model learning and parameter uncertainty is really just semantically different. I put in this as a parameter. It has some value, and I'm trying to learn about it. And so the probability that the Bansal-Yaron model is true. It's just the expectation of M conditional on the history. So with that in mind, I just used the standard base rule stuff that I've already used. Okay. So let me just give you some intuition for what's going on in this model. So I'm going to show you sort of a lot of action and risk prices that come from this. Think about an Epstein-Zinn type setting. Here's an Epstein-Zinn utility function. But think about that where next period someone will tell you which model is the true model. Okay? You will literally know, is it the IID model or is it the long-run risk model? Okay? So if you go inside this certainty equivalent, there will be sort of a probability that the certainty equivalent will be the certainty equivalent in long-run risk, which is pretty low, right? Long-run risk model is a more risky model. So that's a pretty low certainty equivalent. And then 1 minus your current belief about which model is true times the IID certainty equivalent. Now the IID model is a high next period value function. So what you have is you have these two value functions that have very different values, right? Long-run risk down here, IID up here. And basically, if someone's going to tell you what's happening, what you have is a crash realization at some level. If you're told the long-run risk model is the bad model, right? Even though you really think the IID, or if you're told the long-run risk model is the true model, if you really think you're close to the IID model, so this is a low probability, it still is like a crash for you. It's like a model crash, right? You're going from, I'm happy in my cocoon, the world is nice, all of a sudden, you get this this bad news, and so you can really think of this as kind of as model crashes. Okay, when you flip from one model to the other, and they can have big impacts on risk prices. And I think this is pretty interesting. And so I'll just show you. First of all, if you're thinking about a prior where the true model is IID, you start with a prior of 50-50, and then you start learning. Okay, 100 years go by. Now your prior, after 100 years, your prior would be that the probability of the long-run risk model is only 19%. After 200 years, the probability of the long-run risk model being true is just 8.9%. After 300 years, the probability that the long-run risk model is a true model is 4.3%. Right? So now you're really starting to unlearn. You're starting to say, hey, it's not the IID model, it's the long-run risk model. And of course, if you have an infinite sample, you will know that's the truth. But look at the risk premium here. The risk premium starts very high, 4.7, then goes very slowly down. It remains high despite the probability of the long-run risk model being true, being very low. So now if you knew that the IID model was the right model, the risk premium would be 0.72% per year, nothing. But the fact that you're entertaining the possibility of this model, which is pretty bad, actually with these preferences, okay, as you can argue, maybe you don't like these preferences, but with these preferences, you really get a huge risk premium here unconditionally, even though you think the model, you would reject this model in standard likelihood. Land, you would say this model is p-value, that model is too low. I'm not gonna think it's the long risk model. I'm going with the IID model. But you see that this agent really worries about that. So here's what I'm going to do. I feed this model. I start with a prior, the 200-year prior. I start in 1947. I say the probability of the long risk model is 8.9%. Right? I estimate. I use parameters estimated on full sample for the other parameters, and just learning which model is true here. And then I'm just saying, what's the probability that the Bansal-Yaron model is true? You start here. There's a little upward tick, but then you quickly kind of unlearn it, and it seems like the probability is close to zero. And then at the financial crisis, actually, because there you had a lot of persistence in a bad state, you get this huge jump in the probability. Okay, but most of the sample, nothing happens here. It seems like. What happens to the conditional annualized price of risk over the sample? Well, it varies a lot. It goes from negative, or I'm sorry, not negative. This line is the IID benchmark. This dashed line is the long-run risk benchmark. So if you're either thinking it's long-run risk or IID, you would think that it's either the dashed line or the solid line. What you're learning, however, what you're observing, however, is that the price of risk, the maximal Sharpe ratio in this economy, can vary widely between sort of minus 0.15 to 1, right? Despite both of the benchmark models not having any variation and the bounds, they're often way outside the bounds. So it seems this model risk is generating kind of extra risks, and they go up in bad times in this setting, except the dot-com bust somehow. and down sort of generally in expansion. So this seems very much consistent, but remember, if you, econometrician who goes to the consumption data will just observe homoscedastic boringness, right? Or close to it, because that's what we kind of feel. Maybe there's some time variation in the sample when we feed it actual data, but you know, so this is what's going on here. The conditional annualized risk premium again goes outside the bounds and displays substantial variation, high in bad times, low in good times, from just learning between two models that we have put on the table. So this question earlier, how do you choose what models to learn from? That's a great question. I don't have a complete answer to that, but in this case, this is sort of the literature has debated this, and you see that there's learning about this is very potentially gives you a lot of action. So at low model probabilities, basically you have a danger of a model crash, okay? And agents dislike state of the world where they're more risky model. By the way, I should say this. What happens? Why does the risk price go up in bad times? I forgot this, sorry. So here's the intuition for that. In bad times, right? When you filter the XT, where are we? Here, you're getting the XT process for consumption under the model of the Bansal-Yaron model. In recessions, you will infer that this value is low, right? So in expansions, you will infer that this value is high. So, okay, we get this counter-cyclical price of risk. Why is it happening again? Well, it's happening because the distance between these two models is changing. In bad times, the long-run risk model is worse on average because XT currently is low. So it's really bad to find out in the bad state of the world that the long-run risk model is really the true model, and you're going to have this low consumption for a long time. In an expansion, XT is high, so you don't like the long-run risk model because it's more risky to you. But if XT currently is high, well, then at least you get this high consumption growth for a while. So now there's less distance between these two alternatives, and so there's less of this crash risk. And so that's really why we're getting this dynamics. We're getting that endogenously there is bigger difference between the two models, and thus more of a model crash risk in bad times than it is in good times. Okay. So those are the dynamics here. All right, so the takeaways, I think I talked through this. There's time varying probability of sort of a model crash here, or time varying amount of model risk. The Sharpe ratio is very sensitive to the variation in its probability, just as it is very sensitive to variation in actual crashes. So consumption probability crash, even though it's a small, probability event, it's very sensitive to variations because when it happens, it's a bad thing. All the model dynamics they're homoscedastic, the underlying models. But in this model, you get tons of variation. Okay, so it looks like you have time varying risk aversion. Okay, in this model, of course, there is ex ante predictability because I am getting time varying risk here. So let me talk a little about some shortcomings, and you guys can ask me if you want. There are lots of things. There are shortcomings there. One thing is over time, investors eventually learn true parameters and model. And at some level, we have a sense that maybe the world is kind of evolving. So there are a couple of issues. One is that it's a non-stationary model. You can look in these papers if you want to see how we solved it. Basically, we have a sort of backwards recursion argument. So it's not sort of very standard value function iteration. It's important to focus on cases where learning is important for utility and important for risk, but it takes a long time to learn, right? Those are the things that we think are sort of important here. You can think about entertaining structural breaks. I don't know exactly how to think about, especially if you have to learn if a structural break happened. I think there are lots of questions of how to make this a little bit more realistic. Question from Chao Ying. Very good question. I think you need the same assumption of preference parameters as long-run risk. Absolutely. I didn't highlight that enough. So if you want to think about the priced dynamics, you need to be averse to the long-run risk, right? You need gamma to be greater than 1 over EIS. Okay. If you have power utility, then you won't really be averse to these long-run risks. Now, we're still getting time variation, risk premium, et cetera, but it might not be as big. The reason we're getting it is that it still affects the volatility of the equity claim, right? It still affects your expected growth forecast. So you still get a lot of variation, but it might not be as much. in terms of risk pricing. So that's a good point. I want to say one thing about these models that is a bummer is that it's difficult to solve them. Very quickly, when you start learning about parameters, you have to keep track of the priors, right? And then there are some parameters that are governing the state space. They're sort of the state variables, added state variables. So very quickly, you got a curse of dimensionality. Okay, so that's why we sort of focused on a few parameters to just show you what's likely to be important here. I want to highlight that, you know, I have no idea how well this would work, but there is this idea out there that neural networks seem to have some benefits for high dimensional problems in the sense that it's not as prone to this curse of dimensionality issue. And so you can kind of take a look at that. All right, one more thing I want to mention to you guys. There is something called anticipated utility that is useful too. So now we're really abstracting away from the pricing of the risks and just thinking about expectations. That's been advocated by Krebs, been used by Cogley and Sargent. Basically, the idea is the following. It makes it much easier, okay? But you don't get a lot of this ex ante risk pricing. The basic idea is the following. At time t, solve the model assuming the parameters are going to be constant forever at your mean beliefs. So there's no parameter uncertainty when you solve the model at time t. So you solve for prices, everything. Then at time t plus 1, you solve the model again, now with t plus 1 beliefs of the parameters, right? So you think the parameters are, you update your beliefs about the parameters, of course. So now there's different parameters. And so that does give rise to a lot of movements in the prices, but you don't ex ante price it because you're being not rational here, not fully rational. Okay, so we do this in the paper. This is Lars Lochstoer and Moore. This is a JF paper. We solve a high-dimensional learning problem with particle filters. We got unknown states, parameters, and models. We're trying to be as realistic as possible. And we show that some of Idamar's questions earlier, we generate large in-sample predictability and little out-of-sample predictability. And we find that when those beliefs correlate, you know, revisions in beliefs correlate with returns more than standard macro outcomes. And we get that long run, you know, yields, long run assets are volatile. So the same as I showed in this oil example, we don't get as extreme, of course, but long run yields, real yields are as volatile as in the data, basically when we're allowing for this type of learning. Whereas in a standard, you know, stationary setting with known parameters, there's very little volatility in long run yields because the long run is nailed down, you know. Okay. So that's what I have on price parameter uncertainty. I want to give it to you because it's kind of a rational benchmark. And so if there's any questions on that, I'll take those. Otherwise, I will move to sort of non-rational learning. But I think we should maybe grab a break now, and then I'll talk about non-rational learning after. And if you have some questions, we can talk about that. So let's break. You don't have a 15-minute break, I think. So maybe let's break until 10 past the hour. Is that good? I don't know if there's any. I'm going to say that's good. So let's break till 10 past the hour. Okay. So let me know in the chat if you can't hear me, but I think it's okay. So any questions? So there's one question here I'll take, and please ask more questions. I know it can be a little complicated first time you kind of see it. So as you showed, it's important that the agents cannot keep learning for a long time. There's a second part to this, but yeah, but you know, long as in hundreds and hundreds of years. That's true. It does. it does, you know, it just lasts for a long time. So I don't think, you know, it's that big of an issue in terms of that, you know, they don't learn very quickly, at least. But you're right, they will learn, you know, and there are two things to say about that. There's sort of either there is some forgetting in the economy, right? There could be this idea that you know, people were living in a time and they experienced what was going on in real time, but they're not able to convey that to future generations, and so there's just something is lost over time. Maybe some data is there, you know, but something is lost in the economy. So you got to kind of put that in. If you want to make learning last forever, you got to put that in, or you got to make the world always change in a way, kind of non-stationary. But that's tricky because you have to ensure that when you solve your model, you know, everything is well behaved. Non-stationary environments are difficult, and also how do you model that is an unanswered question. So the second part of the question is, except overlapping generations, is there any other way to generate that learning? Yeah, so I think it is. You have to have structural breaks of some form. Structural breaks are really tricky because, you know, if you observe the structural break, then you could actually probably solve these models. But you would get these like jumps in uncertainty, and then we come back down, a structural break, jump, we come back down. But then you reset the learning, right? So I think that totally is doable. One thing I really wanted to solve, which I was never able to do, is the idea that, you know, there might have been a structural break, right? You just don't know. You think maybe we went to a new model here because something really changed in the economy. And so going back to that oil example, you know, China didn't used to be this international player, and now it really is, right? And so something has changed in the way the economy is organized. And I'm not exactly sure if that's a structural break, or if, you know, it's just, you know, okay, China came in, but we're going to continue doing the same thing anyway. It doesn't really matter, right? So in the oil market, it looked like a very clear structural break, but it's not so clear otherwise. So I wanted to solve a model where you want to learn if there was a structural break, right? But the problem with that in a totally rational setting is that now you have to consider a structural break at any time. And what's the structural break today, yesterday? And so very quickly you get high dimensional stuff. So I think it'd be super interesting if you can kind of solve, you know, kind of let us know how should we think about those learning problems and how agents attack those when, you know, the dimensionality in terms of a number of state variables can go very, very rapidly up. And in the limit, you know, if you have an infinite history, there could be an infinite different structural breaks. You have an infinite dimensional state space. And so somehow that obviously it can't be what investors are doing. So somehow there needs to be some sort of shortcut there. But I think that's a very interesting question. I don't have an answer to it. I was never able to solve, you know, I'm ashamed to show you how little I could actually solve for. And so it would be great to make some headway there. Any other questions on this? Okay, so I'm going to move on now to non-rational learning. From rational, we really learned that, you know, we have this persistent effects. If you have certain preferences, like Epstein's preference for early resolution of uncertainty, that can really generate a lot of risk pricing and a lot of exciting conditional risk pricing. It also affects, you know, kind of accounting of ex post versus ex ante when you measure risk premia. If there's a lot of parameter model learning, you know, you going back as an econometrician with the benefit of hindsight, right? You know the sample mean, and so you impose that as a fixed parameters. Well, the agents didn't know the full sample mean, and so sometimes the price looks too high to you because it's like above the sample mean, but the agents didn't know that in real time. So those are sort of the two main things that you're getting from this. Okay. I want to talk about non-rational learning and surveys. I think it's a very super interesting part of the profession. Have sort of gravitated towards this. I call it introduction. I call it new behavioral because behavioral has been around for a long time, but somehow now, you know, with the advent of more survey data, we really take it more seriously, I think. You know, it's not that necessarily all investors behave like people in surveys say, you know, in terms of their expectations, but it's reasonable maybe to think that some do. And And on the other side, the rational people might have some of these real-time learning problems that they're dealing with. And so I think both of these views are going to be important in models. So I want to talk a little bit about experiential learning and putting that into a macro finance model. Malmendier and Nagel, kind of the standard there. I want to talk about, there's this very cool paper by Kobion and Gorodnichenko, I hope I pronounced that okay, about they look at sort of stickiness and forecast errors and show that, you know, if you look at macro forecasts, a lot of times you can predict the forecast error. And that really shouldn't be the case if you have rational expectations, and or at least if agents update expectations every period in a rational way. So they sort of find as average expectations have stickiness. The third paper I want to sort of highlight here is a paper by Landier, Ma, and Tesmar. It's a working paper. Basically what they're doing is some experimental large-scale experiments, and they find that individual expectations exhibit over-extrapolation. So sort of too high persistence. So I'll talk about that too. And so I think these are kind of really interesting elements to consider in our model. What you'll see is that, you know, on the one hand, we had these learning problems and, you know, they quickly became complicated. Here we have this sort of very simple reduced form, intuitive, but you know, admittedly somewhat ad hoc learning rules. They're sort of very simple. They don't depend typically on things that I think probably they should depend on, which is the state of the economy, or is it a new regime or is it not? I would think that learning does depend on you know, whether you're learning about something you really know well and have seen many times, or if it's a new thing. So I think this is like the first models here are for sure too simple. I think there's lots to do here. And I'll talk about this at the end. Okay, last half hour I want to spend on sort of future research and things to do. So let me talk about Malmendier and Nagel and then do the stickiness and over-extrapolation. And so please ask questions, okay, as you go along. I know it's Friday and it's getting late, but still. So if you haven't read Malmendier and Nagel, they have sort of two papers, one 2011, one 2016. Somehow I cited them at 2013 as a working paper probably, but this is now published 2016. And what they find, right, is this idea that is really intuitive, I think, which is when forming macroeconomic expectations, individuals put a higher weight on realizations of macroeconomic data experienced during their lifetimes compared with other available historical data. So, you know, if you lived through a particular inflation period, you may put more weight on, like, you know, the Volcker period, et cetera. You might put more weight on the likelihood of those states happening again than someone who just has recently only experienced very, very low inflation, right? So it's kind of at this time it's different bias, okay? So the idea here is that it's not that the world truly is different. It's just that the young always will tend to think it is different, you know, because the old people, what do they know? You know, it's a new world. But in this case, that is a behavioral bias, okay? So what Malmendier and Nagel do is that they look at inflation forecasts. They have two papers, but a 2016 paper I think is the most relevant here. You look at inflation forecasts and just ask, how do you use data to estimate the model? And if you're Bayesian, you should weight all data equally, right? All data is equally informative, right? So the weight you put on the data, and they're estimating here an AR1, and they're estimating the mean and the autocorrelation coefficient. And so what they find is that the young here at age 30, they put basically weights in their lifetimes, but not before they were born. And they put more weight on the more recent observations. Whereas if you're 70, you still put more weight on the recent observation, but you smooth it out over your lifetime, but it does sort of go away. So somehow people think, you know, that the stuff they lived through is more salient. That makes some sense to me. Unrelated to the paper, I had this quote here from Wall Street Journal, heard on the street. The Fed survey shows how much age matters for inflation expectations. People over 60 expect inflation to come in at 3.4, while people under 40 expect 2.8, right? Because if you're younger, you only experienced in the US and Europe and a lot of parts of the world, developed countries, low inflation. So this represents a shift from the 70s and 80s when it was the older cohort to experience less. So that's a bias we can think about putting in and joining in these models where you're learning about parameters. The young will tend to use less data than the old. And that is a way of generating learning to last forever. Okay, so I'll show you some of the effects you get from that. I think it's a nice way of doing it. So I'm going to show you, I know my paper is the best. So I'll talk about my paper with Conditional, friend Jensen, Lochstoer, and RFS, with myself, in fact. There's also Elin Graniero, Herda Larsen, which, and the Nagel, Stefan Nagel, has a sort of representative agent version where you don't have heterogeneity, but it's the same idea embedded. So putting it in the rep agent framework makes it a lot easier, but you do lose out on the relative wealth shares, etc. So I want to say a couple of things. It is instructive to see how heterogeneity in parameter beliefs plays out in the equilibrium model, and the risk sharing is very different, okay? So I'll talk about that too. All right, so I'll show you how this might work. And so this is how we did it, okay? And this is to this question, and it's like, how do you make learning last forever? You know, there's got to be some forgetting here. So we have an exchange economy with IID consumption with these IID disasters, okay? So there's a disaster with probability P, and then it's a very low outcome, D lower bar. And so, and then we have, you know, we don't know about the mean. So agents learn about the mean and the variance. And I won't go through all the details because I think, you know, it might be too much for today. But basically, you're learning about the mean, you're learning about the disaster probability. We know these things matter. We know you don't learn that quickly about it at the end of the day. But the key thing is that people die here. You know, they get born and they die. And when they die, some knowledge is lost. So we calibrate the model to the US Great Depression, sort of a one-off drop is minus 18%, et cetera. So it's a little extreme, but it's just for showing you. So here's what we're doing. So here's how you see how you could do this. So a generation is born with a prior over the mean parameter, which is normal, because that's the conjugate prior here, and a prior over the disaster probability, which is beta, okay? And so when you solve for the, and this is, we do this in the appendix, but I'll just give you the highlight here. When you solve for the subjective dynamics of this particular agent, a generation I, okay? The mean is gonna, you know, the consumption is gonna have a mean, which is the best guess of this mean parameter, plus there's gonna be a component coming from the disaster. And then there's gonna be, of course, the shocks, the realized disaster versus what you thought was gonna happen, and the shock to the mean, okay? So you've got these two components now. What I want to just, again, say, okay? We let the agents be Bayesian within life. So we don't actually do exactly what they're doing, but we are going to have, so within the life, you're going to use the history equally. You're going to weight it equally, but then you're not going to use anything before, very little before. So their mean beliefs are again martingales. The mean probability of disaster is again a martingale, and you update if there is a disaster or if there isn't. It's an indicator function to say if it is or isn't. And so there are these shocks, and there's this mean beliefs, and then the precisional beliefs is, again, you learn more as time go by. Okay, so that's the setup. And so at this point, you should just have sort of a vague sort of understanding that, okay, within each generation, I'm learning about the mean and the disaster probability. Again, I get these permanent shocks every period. And so what we do is we just let agent live for T years. So basically, we let people live for sort of 40 years of financially active lives. You could change that, you know, it's just a number. The key thing here is we let them inherit their parents' mean beliefs, but increase dispersion. So when your parents die, they give you all their money, they endow you with beliefs that their mean beliefs are the same as the ones when you're young, okay? Both about the probability and the mean parameter. Probability of disaster, mean parameter. Here's the key, this K parameter. The dispersion of beliefs, which is basically effectively saying how many periods of time have you already observed to learn. We're going to bump it up, okay? So we're going to set this K so the young has much higher dispersion of beliefs than the old. So it's like the following. Your parents tell you how the world works. You say, yeah, that sort of makes sense, but I don't quite believe you. I got to have to see this for myself, okay? So that's kind of the idea here. So this solves this problem, and we set this K such that, you know, we have sort of a steady state amount of uncertainty. It never goes away. And we can do that because this is a time counter effectively, okay? Okay, so the young is going to update more than the old because the updates are a function of how uncertain you are, how big the A is. And the young has a much higher A than the old. So young are going to be more uncertain. They're going to update more and more volatile beliefs, etc. So here's how it is. This is our version of an OLG model. So it's solvable. That's nice. We have two dynasties, A and B. They sort of phase shift in terms of who's old and who's young. So dynasty B can start off as old. When the old die, they give their money to the young. They're then young for 20 years. Then they're old for 20 years. And then when they die, they just learn as a Bayesian throughout here, just sequentially, all this time. And then when they die, they give their mean beliefs and money to the young. And this other dynasty is just offset in the face. So when this dynasty is old, these are young. So that way we have two generations always. Okay? And so now we can replicate all these kind of, there's a lot of this evidence in Malmender and Nagel. But what it really does is it keeps learning going forever, right? So that's the main idea. So you can do this. It's a little hard because you have to solve a heterogeneous agent Epstein's problem, but we show how to do it. There are different ways of doing that out in the literature now. And if you're interested, you can shoot me an email and I'll give you some references. But this is a way, so now this thing keeps going. So what do we get? Well, because you have parameter uncertainty forever, you get a high risk premium if you have Epstein's preferences. There's no cash flow predictability because in truth, everything is IID, right? But the PD ratio is very volatile due to time varying parameter beliefs. And I want to mention there's a paper, I forget the other, one of the authors is De La O and the other guy, I just forget for a second, I think it's Stanford. And they sort of show that, if you look at expectations versus the price dividend ratio, a lot of the volatility lines up with the expectations of agents about growth rates. So that's kind of consistent, right? No cash flow predictability, but if you're an econometrician with a long sample, like a 100-year sample or something like that, you would find that the price dividend ratio predicts returns because these agents make a mistake. They get too optimistic and too pessimistic. Okay, so that's how that would work, and that's one way of getting around this problem that Chao Ying here asked a question about. Model learning is perpetual because you're forgetting something. So. I want to say one thing that I think is kind of interesting, despite difference in beliefs, sometimes, the young are optimists or the old are optimists, right? And the young are pessimists, for instance. They have different beliefs. If you're an optimist, you are reluctant to insure pessimists if you have Epstein's preferences and you're uncertain about the parameter. And so why is that important? Well, if you have... This paper by Chan, Jocelyn, and Tran says that, if you have power utility preferences and you have disasters, if you have power utility preferences and disasters, you have an optimist and a pessimist. About, the optimist think the disaster probability is low, the pessimist think the disaster probability is high. The optimist is very happy to insure the pessimist. And what that does is basically in power utility model kills off the risk premium to a large extent, not fully, but to a large extent. That doesn't happen with Epstein's if you have parameter uncertainty, okay, to the same extent at all. And the reason is, even if you're optimistic, you're unsure about your beliefs. And so that's kind of what's going on there. So you don't want to insure as much. And I think that's an interesting thing. I have a question. Can I ask what state variables are in the economy? Yes, you can. I glossed over it. State variables are here. It's the mean belief of the young, the mean belief of the old for the mu, the mean belief effectively of the disaster probability, summarized here by counter AI. It's all in the paper. It's related to the expected probability, as well as a time counter for how long you've been alive effectively. So there's 3 state variables, but this is time. So that one kind of is shared between young and old. Both are subject to time. But we got the young and old mean here, young and old here. And so if you solve the total thing, you got 4 state variables for the mean beliefs plus the time, right? We solved the 2 separately. We solved one with mean, one with disaster probabilities. We only have 2 plus time, and those are the state variables. Okay, so all those are great questions. Those details are in the, and also there's a relative wealth of the agents, I should say. So those are in the paper. it's hard to solve these models for sure. Okay, I just want to show you what you get. You sort of get that the volatility of the price dividend ratio is really high, even though in the benchmark economy, it should be constant, right? So you get this excess volatility. It's belief volatility for the mean. This is just for the mean. The standard deviation of the shocks to the mean forecast is 0.1%. So tiny errors, right? But they have a really big effect here. The absolute level of mispricing relative to the average, because it should be constant, is 20%. So the market is sort of always 20% mispriced on average, I should say. But it's very persistent, you know, so it takes a long time to go away. Okay, if we think about this as effective risk aversion and say, hey, the maximal price of risk in the economy as you observe it should be, because everything is IID here, should be risk aversion times the consumption volatility. Well, in this world, it moves over time, because sometimes investors are optimistic, sometimes they're pessimistic, and the average level looks a lot higher. So you get sort of an average observed, what looks like average risk aversion of 20 with a volatility of 7.3. So it looks a lot like a habit formation model. Okay. A general question is, does learning long risk combined with easy preference imply downward sloping yield curve, real curve? Yes and no. So I talked about this earlier. It does not so much when you have the parameter learning. That's the infinite horizon where no one forgets, okay? And the reason is that, yes, you have this long run risk, but since you're learning over time, your precautionary savings motive actually goes up. And so that counteracts this downward pressure from the long run risk, okay? So we show in this EAR paper that that's not the case. In this paper, it's more the case because we have something that looks a little bit more, but it's still not very downward sloping. So I don't have the result right here. But again, because there's infinite, the agents think themselves they're going to learn in the future, right? They think they're going to learn, and so they have the same expectations about the short rate that it will come up. So, so it's not nearly as bad, yeah. And we don't have excess cash flow predictability. That's a good question. All right, so I think I'm going to move on to another set of models, and I'll talk about future work. So I want to talk about, unless there's any questions about Momentum and Nagel, I want to talk about some very recent, work on surveys and expectation formation. And if you haven't seen this paper, I really recommend that you do look at it. This is by Koibyan and Gorodnichenko. And what they do is that they look at a bunch of survey data on macro surveys. Okay, it's an AAR paper. You should look at it. And the basic test is motivated by stick information model of Mankiw and Rice. And so that model, you have that agents are kind of rational, but they only update their beliefs with probability 1 minus rho. With probability rho, they will just stick to their old forecast. So there's this stickiness, okay? If you aggregate across agents, you get that the average forecast looks like this. So basically, there's some agents that are going to take the rational expectation T minus J periods ago and apply it today to the problem of forecasting the future. So they're going to use an old forecast because they haven't updated. They've been inattentive or it's been costly, okay? And because it's the probability 1 minus lambda that they will update information, you get this kind of exponential moving average here of past. So you get what looks like sticky forecast, right? The forecast isn't entirely up to date, okay? And so the test they have is the following. So if you do some algebra from this, and I don't go through all the algebra, what you get is the following. The error in expectation here, so the realized error, the realized macro variable minus the forecast, the average forecast across all agents, okay, is related to the update in past forecast. So if you look at their past update in forecast, and there's some noise, this thing predicts the forecast error. Okay, if you're fully rational and update every period, you should not be able to predict forecast errors. That means you're not rational. Yeah. So the fact that they can, or it means it's costly to update. So the fact that what they find here is that this coefficient is generally sort of large and positive. So they find pervasive evidence of stickiness in the average forecast. Okay, so that seems to be something that's important for understanding at least a subset of investors. Okay. So that's Korbian and Gorodnichenko. I want to also just mention another piece of experimental evidence that I find super interesting. This is for Landier, Ma, and Tesmar. It's a working paper. They do large-scale experiments with monetary payouts on students, okay? And the true process is an AR1, and they're going to look at different levels of persistence in different experiments. And so what do they find when they ask, these students, by the way, are students that in many cases are, you know, engineering or something like that. They understand what an AR1 is. You know, they're sophisticated. They give them data. They ask them to figure out the true process and forecast, right? Realized data. So they find this very robust finding at the individual level, agents overreact. They use sort of too high persistence, okay? And so they tend to sort of over extrapolate by thinking that whatever is happening right now is going to last longer. Okay, so if you look at this graph here, here's the AR1 persistence. You see that the subjective persistence is always higher and more so if the persistence is low, right? Now, partly, you know, persistence, this is a big difference if the persistence is 0.8. 0.8 and 0.9 is a very big difference in terms of half-life. So that's part of what's going on, but you can sort of see this bias is pervasive. So it's also related to a recent paper by Bordello et al. On sort of diagnostic expectations, and then, you know, there's this idea that there's individual over extrapolation, but in the aggregate we find some stickiness. Okay, so I'm going to kind of I'm going to think about putting those things together and see what you get from that in a macro in a model, and so here's doing that, and I think that can give us some interesting stuff. Consider a true AR1 process. So here's an AR1, that's a true X process. There's a rho parameter. Individual agents make a mistake. They believe rho is really rho tilde, which is too high. Okay, so I'll take that in a second. So these guys think that the persistence is too high relative to the truth, and they sort of extrapolate from that. Agents update if the agents also update in a sticky manner, so, you know, we get this over extrapolation, but they don't update all the time. The average forecast kind of looks like this. So the average forecast to just do one period ahead of X is you know, these lambdas, and the lagged forecast, the individual lagged forecast is sort of rho to the J from, you know, you were back there, you're trying to forecast this many periods ahead, you use that data, but you use rho tilde. Okay, that's your forecast from an AR1, and then you have this stickiness. So if you solve this out, what you basically get is like a 2-parameter forecast. There's a lambda tilde, I call it. There's just something multiplying the sum, and then you have this phi parameter that extends back many periods. Okay, and if you're rational, you would only this phi thing should be equal to 0, right? And so you use the most recent information only. And this lambda tilde should be equal to rho, okay? That would be the rational benchmark. But because of the stickiness and individual over extrapolation, you get this function. I'm going to use that in a paper and show you what that gives you, okay? But I think it gives you some pretty interesting dynamics. So, question, there's a new paper, Pedro, Gianoli, Ma, Schleifer, documented overreaction individual macro expectation. Yes, exactly. I think that's exactly what I think this is kind of capturing that individually, you know, they overreact. This rho tilde is higher than rho individually. But there's also this stickiness. There's sort of these two things going on together. And I don't think any of the papers sort of, you know, I'm not sure to what extent they're really capturing, but some of them are capturing one and some of them are capturing the other. This is just a simple way to put them together, okay? That individually agents overreact, but some, when you take the average across, they're kind of sticky, and that's what they find, okay? All right, so I'm gonna look at a model here, and again, you know, I'm going to talk about my own papers because I know them best, and I can also tell you what's wrong with them without anyone else than me getting, or my co-authors getting upset with me. So we're going to use these preferences as a description of agents' belief about return variance. And in doing that, we're going to be able to explain failure of the conditional risk-return trade-off at the stock market level. But the main thing is just to show you how we put those into a model and show you what's going on. This is also related to a paper by Brooks, Katz, and Lustig about how agents are updating about FOMC announcements and how there's some sort of stickiness and then subsequent overreaction in those. So I'll just show you that, and then I'll try to be pretty brief because I want to talk about sort of future work. So we're going to have a model where agents are going to make mistakes about variance, and I'm going to show you this updating rule, and we're going to sort of just put it in there, okay? And I'm going to also look at survey data and show that this is consistent with forecasts of variance. So here's our model. We're going to have dividend growth, very simple model. Agents are going to eat dividend growth. It's got constant mean. We're going to shut down all the long and risk stuff. It's got time varying volatility. And the variance follows an AR1 process, okay? So this is kind of a standard setup. They're going to make a mistake here. That's the idea. Also, just note that sigma t is realized at time t, so they don't actually know the variance. The realized variance is going to sort of be different from what they expect, okay? The expectation of sigma t epsilon t is 0. The conditional variance is the conditional expectation of sigma t squared, okay? So you can show that, and that's because these things are uncorrelated. So a couple of things. Variance has normal shocks as an AR1. That sounds horrible because now variance can go negative. That's true. We also do gamma shocks to keep it positive, but this is standard actually. Bansal-Yaron do this. So we're going to stick to that assumption because it's just easier, but we can solve the model without it. So here's what I'm going to do though. And I'm going to show you that this helps to explain something that's really puzzling and really an issue for all our models, okay? Beliefs about variance now are going to have an S on them. They're not going to be rational. They're going to have this sticky element to them. So I'm just going to go down to the bottom equation, okay? So define X as this distributed lags of past variance. You're going to observe the variance at time t. They don't know what it's going to be next period, of course, but at time t, they observe the variance. So your expectation at t-1 is going to be the sum of the past, okay? Or time t here. Sum of the past variances, and this phi is going to determine how much weight you put on them. Now, the variance is an AR1. So if you want to forecast it, the phi should be 0. And then I have the average variance to get right. Lambda is multiplying this thing. And so if lambda is equal to rho, we get the rational. Okay, phi equal to 0, lambda rho, we get rational. But if lambda is positive or is higher than rho, really, we get this over extrapolation in terms of the persistence. And we really get the stickiness, I should say, not degree of extrapolation, the stickiness from phi on those lags. So I'll just show you how that works. So how it works is the following. If variance is a true AR1, if there's an impulse response there's a positive shock to variance, it goes up because in the data here, the true autocorrelation function is 0.72. Your expected variance for a 1 standard deviation shock is 0.72 of that shock, right? And then it comes down in the impulse response, just like an AR1 always does, right? Rho squared, etc. In our model, we're going to do the blue line. We're going to have some stickiness. Phi is equal to 0.6. We're going to estimate that from survey data. We get the lambda is greater than rho to get at this over extrapolation part. And you see it governs the scale here. And so if I take a impulse response of the actual one period sort of expectations after that shock, what happens in the first period is that because phi is 0.6, you do update positive when the initial variance is positive, right? You do, as you can see it here, you do care. Phi is 0.6, j is equal to 0. Okay, you're gonna care about that initial variance, but you're also gonna care about the lags. So this one doesn't go all the way. Why doesn't it go all the way? Because you're also effectively caring about this point, and that's 0. So you're taking a moving average here. Okay, so you're sort of smoothing this impulse response. It's just sort of a moving average of the truth. So the first period, your expectation goes up, but it doesn't go up enough, okay? So this is the true expected variance. This is your expectation or the agent's expectation. When the actual variance on average comes in here, you're going to update, oh, that was a positive shock. I'm surprised, right? And so now you're going to update, basically it's going to be a moving average of this point and this point. And so you're going to sort of slowly, so you get this initial underreaction, subsequent overreaction, okay? That's what these give you. If you have a persistent process, you get initial underreaction, subsequent overreaction. If the process is not persistent at all, you always get overreaction. Okay. So that's what we're going to have here. So I'm going to explain the baseline of this model now, just from this, okay? And so we are going to be explaining a very strange phenomenon empirically, which is the following. When you look at variance markets for stock return variance, if the variance shoots up, okay, if you're in the business of selling variance, okay, you're going to be losing money afterwards in the data. So when variance is high, current variance is high, so VIX is high, you know, if you're shorting volatility, you actually lose money the next month, which is kind of counterfactual, counterintuitive. But this explains it. Why? Because when you're selling at a price that's too low, and this is the realization that you'd be owing, right? So you're selling here, and that you pay this later on average, and so you lose money here. So initially, when variance is high, after variance shock, you lose money on variance contracts. But then after a while, you make money. This also affects the conditional risk premium. There's a pretty strong stylized fact, which is the VIX does not predict returns, okay? If you regress next month's excess return on the market on the VIX, you get a 0 coefficient or a negative coefficient even. If you regress it on actual lagged realized variance, you typically get a negative coefficient. But you would expect risk premium to go up when variances go up, right? That doesn't happen. Well, here it doesn't happen again. Why? Because your expected variance goes up, so your expected return goes up, but the next period you're surprised by how high the variance is, so that pushes prices down again because you have, I need even higher discount rates, so that counteracts it. And then subsequently you get a positive response. So I'll show you this in the data, okay? So here's what's going on. Now I'm adding these type of preferences in a general equilibrium model. I can solve for the model. The agents still it's pretty simple to solve for. You have this x as the state variable. That's their expected variance. The risk premium, the subjective risk premium, is the subjective variance times the risk aversion. This is a Jensen's inequality term, plus a constant. My variance shocks are constant, so this Epstein's in, but it has nothing to do with early resolution of uncertainty or anything. This is slightly positive, but it's basically 0. The objective risk premium, however, looks like this. It's the subjective risk premium plus the error, something times the error, okay? That is the difference between this and this. And so if your subjective expectation is less than the objective, which happens after a positive variance shock, this is a negative number, okay? The true risk premium, and these are positive constants. If the A is greater than 1, their true risk premium actually can even go down, even though this goes up, because they're going to revise expectations of risk premium volatility next period in a predictable fashion. Okay, so so this is buying you sort of a lot of sort of interesting impulse responses. The same in the variance market. If you have realized variance is equal to the dividend volatility plus the stock return volatility, you say the price volatility is actually constant in this model. It's just a constant. You solve for the risk neutral variance. That's the expectation of the stochastic discount factor, risk-free rate times realized variance. You get that the VIX is just, basically a constant plus the subjective expectation of dividend variance. I can get the variance risk premium as the difference between the VIX squared and the expected variance under P, the true expectation of variance. That variance risk premium is moving because of your mistakes. The model has a slight positive coefficient here. So the variance risk premium is negative when you underestimate future variance relative to the truth, or in positive the other way around. Okay, so variance risk premium, you see, shows up here and in the risk premium, same thing. And that gives us why the variance risk premium in this model can predict the stock return with a positive sign, whereas actual variance might not predict. Okay, so we calibrate the model. I'm not going to talk too much about that. I'm just going to show you the impulse response. Here's the impulse response to shock to variance. The blue line is our model. The black line is the data. The red dashed line is if agents were rational. And so just to show you what you get here is that upon impact, a positive variance shock, this is all our impulse responses to a positive shock to variance. Prices fall in all cases. In our model, they fall a lot because investors over extrapolate, remember? But they don't, so they're too high persistence, but they don't stop falling there. And like the rational case, go up afterwards because of the mean reversion. They continue down, okay? And then they bottom out and then they go up. And the reason they continue down is because you underestimated the variance. And so the market actually goes down the next period before it starts after 2-3 months go up again. If you look at the variance risk premium straddles, you can look at actual variance swaps, you can look at the VIX minus realized variance, you all get the same shape, which is if the variance goes up, the actual variance risk premium goes down in the data and our model. A little bit too much in our model. We have a bit of a tension matching both these things. The risk premium, if variance goes up in the data, the risk premium goes down in this VAR, okay? So this is in our sample, that's a very strong thing. In some other samples, it's more like it just stays at 0 and then it goes up, all right? So it's not necessarily negative, it's just kind of around here. But the rational models, almost all the rational models predict very strongly that if variance goes up, the risk premium goes up. You know, I don't know of any models that really, that are main models that don't have that. And so we get the opposite, or no response or a negative response to the variance risk premium in the short run because you make this under reaction first. And so you're again shocked, the prices continue down. And that's why the actual true risk premium goes down, okay? So that's what's going on here. This helps us, this type of model helps us explain sort of the volatility managed portfolios of Moreira and Muir so we can understand why the alpha is on volatility timing, where you time the market or any other factor, your portfolio weight is inversely related to the last month's realized variance. And that increases your alpha. And the reason is that variance don't move one for one with the risk premium. In fact, risk premium goes down when variance goes up. And we can show analytically that that gives rise to a negative alpha. In other words, variance up, Sharpe ratios and everything down in the short run and up in the long run. Okay, so that's just an example. I want to give you some survey data. I have 2 surveys that you can take a look at too. The CFO survey of Graham and Harvey. It's quarterly since 2001. All the data is on sort of this web page. The cool thing here is that CFOs are asked a bunch of questions. One of the questions is where do you think the S&P is going to be in 6 months or a year? Okay, and they answer that and they report sort of the mean. But they're also asked individually, they're asked, what do you individually think is the 10th and 90th percentile distribution of where the S&P return will be next year, right? Where do you think it's going to be? And so they give their answers for that, and they report these answers, right? So the median of the 10th, median of the 90th. And so what you get, you can get an estimate of the variance. What is the variance implied by this survey for stock returns? And so I think we're the first to use that as such. And so we sort of square this difference and measure variance. We also use the Shiller survey that asks for probability of a stock market crash over the next 6 months. Not exactly it's not exactly a survey about volatility, but it's a survey of some sort of notion of risk. Okay, certainly it's related to volatility. Okay. So then we do the following. We take the survey measure, the survey's average measure of volatility. So the volatility of each respondent, we just sort of average those. And so we take the survey measure of volatility on the left-hand side from T to T plus K, where K is either 6 months or 12 months, right? For these 2 surveys. And we project it onto lags of realized variance in the stock market, which in our model is the same as lags of dividend volatility. Okay. And then we estimate this fee parameter. The scale is kind of off, so we don't care so much about the mean on the scale. We just estimate how distributed the lags are. And we get numbers that are sort of like 0.77 and 0.73. We had 0.6 in our model. So this is sort of overestimating. It's a little higher than what we chose. But you really get that the survey tells you that when people talk about variance, they really use more lags than they should. Okay. How do I know than they should? Well, we also put future realized variance on the left-hand side. Okay. And we regress on the lags. And then we get a value of phi of 0, statistically, because it's very close to an AR1. It's not exactly an AR1, but it's close to an AR1. And so this seems like there's at least some survey evidence that people are making these mistakes, and that could explain something that's really puzzling, which is the conditional risk-return trade-off is not what we would think it is, which is that when variance is high, risk premium goes up immediately. They do go up, but not immediately. It takes a little while. Okay, so that was just an example of, so I sort of talked about these two behavioral biases. One is learning from experience and how that might affect things, and the other one is the stickiness and this overreaction. So there's initial underreaction and subsequent overreaction, and how you might put these in a model. Okay. Please let me know if you have any further questions. I want to talk a little bit about, I'll take your time and get to those, but I want to talk a little bit about shortcomings again. So everything I've done is like in standard consumption-based models. They're quite simple and abstract, and they're a reason to not like just straight consumption-based models. They don't have a Fed typically being meaningful. They might not have institutional constraints, intermediaries, and so forth. What is more, it's all kind of aggregate. There's no cross-section of firms or industry. I think if you're going to try to learn about stuff, it seems very relevant to think about industry dynamics, right? We're sort of learning about the role of the social media and the market concentration in sort of the big tech firms now, and how that's all working out. And that's so there's lots of these things that are just left untouched that I think could be potentially very interesting to understand some recent phenomena. The main ideas here could be incorporated and joined with literature on financial friction, intermediaries, and institutional investors. And I think that's important. And the reason I think it's important is, think about the financial crisis. So since you are all PhD students, you're too young probably to remember this, but I remember this, in 2008, when they let Lehman fail, that was a big shock. And we were all watching, this very unlikely event transpire, and we're watching people leave Lehman, having been now out of a job with their stuff, right? So it was a very powerful kind of mental image. And I think when you think about what sort of the general investor and their beliefs, I think they are, very much affected by, the salience of a crisis and what's going on. And so I think it makes sense to think about how do beliefs, interact with crisis and with financial frictions and events. And that could serve as, understanding maybe some of the things that are happening in a model with financial frictions and these type of things. So I think that's certainly something you can do. And also with the learning, if there's a new model out there. I've already talked about this, but the world we live in seemed to me to change in somewhat non-stationary ways. And I would love to see someone tell me how to really deal with new unforeseen regimes, new trends. It seems like we're locking down the world and have too little risk. Our investors are sort of very confident about the model, and they have this epsilons, but it seems to me that there's a lot of risk in actually the structure of the economy changing in ways they really, really don't have a good sense. And that tells them something about what the model is going forward. Another thing I'll talk about is trends. There are lots of variables that have trends. And so that seems also to be hard to square with sort of small samples, simple mean reverting models. Certainly it could be mean reverting, but it's very, very hard to learn. It's very long dated then. I've got some questions on this, but what is the menu of models one should consider at any given time? You can sort of take more of a view of, robustness or something like that. But I just really don't have a good sense of what models one should consider. What I will say is when you talk to people about real world changes, they seem to have some scenarios in mind. And I think, they're really thinking about the world in a couple of different scenarios. And those are probably models that are sensible to consider learning about. And just in terms of surveys too, what are investors' belief formation? The experimental evidence about an AR1 is like incredibly simple, right? There's an AR1 process. You're asked to learn about it. What happens when there's sort of structural breaks and things are really changing? How do you think about just the COVID recession? I don't know about you, but I had no idea what this would look like over time, and how this would affect the economy. No idea what the Fed was going to do. No idea, how quickly it would be that the U.S. would be in such a bad shape relative to the rest of the world. And so I think, at the same time, we see some interesting stuff in the stock market, which I'll talk about in a second. But I think we really sort of are living through an episode that we really haven't seen before. People talk about the flu. Well, the 1918 flu, Spanish flu, but it was a very different world back then. So it seems to me like there's a lot of learning going on right now.
Sorry.
Yeah.
Question. What do you think about the disagreement in, say, macro expectations? So now in the last few months, there is a very large disagreement, both among market participants and the Fed officials about the macro fundamentals. And we saw this huge employment report surprise
right.
in June. So, how do you think about that, and how does it affect what we know? Yeah.
I think I think that's very interesting. People could disagree just because they're kind of generally crazy, but I think the reason people disagree now is partly because they maybe they receive some private signals, but the spread of feasible models is just a lot bigger now, right? So it's kind of like, you get some individual signal, but everyone agrees that we're in good times and we're kind of sailing along. There's no big waves or anything on the horizon. So we might disagree, but the set of models is kind of narrow. Right now, when you hit the COVID recession, there's lots of model and parameter uncertainty, right? So I think you could really get people really updating with their private signals to very different models. Yeah. So I think that's super interesting. I think, again, that would be sort of where there's heterogeneity in the models. And I think heterogeneity in models will tend to happen more when model uncertainty is high. So I think that's very interesting. It's interesting to think about a model like that and how that would play out. Yeah. Is it possible to interact agents' beliefs about volatility into modeling financial contagion and/or systemic risk? Yeah. It should be. It definitely should be. These are interesting. Like I said, I think that's an interesting question. And I think what I showed you is just sort of, like I said, these models are pretty basic, and they deal with sort of just a straight consumption-based paradigm. Certainly, if you're thinking about balance sheets, if you're thinking about constraints binding for intermediaries, then the likelihood of a constraint binding should be a function of expectations about volatility and outcomes into the future. So I absolutely think that is a very interesting thing to look at. So yes, go ahead and do that. It seems very interesting. All right, so I want to. Hopefully, you guys can just ask. I'm going to go into sort of some thoughts on future. I just want to give you some references. I've made a lot of omissions. Okay, if you want to think about learning, you should always start with sort of the classic separation theorem, D'Example, Dothan, and Feldham, and Janot. These are sort of classic papers showing that if the world is a nice Kalman filter type world, everything is kind of stationary and nice. Learning is once you've learned the parameters anyway, learning is kind of not that exciting, right? You sort of filter the state and then you go on. And I'm not saying it's uninteresting. It doesn't add a lot to you. So it's really this going into parameter learning. And I should really mention, Pastor and Veronese has some early work on, the effect of learning about the mean and how that can generate the dot-com and high valuations actually, because of a convexity effect, and learning about individual firm profitability and so forth. Lots of papers. There's a recent really cool paper by Kozlowski, Velkamp, and Venkateswaran. I hope I do that right. I wonder if it's forthcoming at the JPE, but they're exactly making this point about, the last 10 years we had the financial crisis. We didn't have this fast recovery. Why didn't we have the fast recovery? Well, it's because people learned something about the distribution of outcomes, and they learned that this financial crisis can happen, and there's now a little bit more weight in that tail, and so they sort of scale back on their expectations and investment and so forth. And so I encourage you to look at that. It's very interesting. Lots of other papers. I haven't talked about robustness and ambiguity at all. Ambiguity will have a lot of the same type of pricing dynamics as Epstein's in. Of course, you could think about this ball of robustness as being related to whether the world is actually changing or not. And I think you should go to Hansen and Sargent for their most recent work on that, if you want to see. By the way, in the virtual finance workshop, Hansen gave a talk on his most recent work on sort of climate change, where you're wrestling with uncertainty, et cetera. And so I encourage you to look that up. Certainly much better than having me try to recreate his paper on the spot here. Lots of paper of heterogeneous beliefs, and I should say also some sort of irrational beliefs here. Hirschleifer and you probably shouldn't be exactly here. That's a rep agent, but they have this overreaction and extrapolation thing in the RB, dynamic stochastic general equilibrium model. I think you should check it out. It's a JME paper. Anyway, so check these papers out. There's lots of stuff going on. Everything is very, very simple. I think there's lots to do. Okay, so I'm going to get to that now, and I hope you guys will join in with some questions. Anything goes. What are empirical observation and questions for future research? So first of all, I don't have the answers, but here are some things that sort of occurred to me. That number one, we do not understand the impact of monetary policy on asset prices. Okay. For instance, we know the Fed purchases assets. Does that decrease risk premiums? Looks like maybe it does, right? But I'm not sure what exactly the model is. I'm going to show you some graph about the recent data, but you probably all know it, right? Equities are back to their highest valuations ever today, right? So is bad times good for equities? I mean, what's going on here? I really don't know what the story is. And I don't think we have a clear understanding and a clear model of this. So why am I talking about this? You spent the entire, 2 hours talking about learning and expectations and figuring out. Well, I think one of the things we're doing is we're learning about the Fed's action. We're learning about the market's reaction to this type of policy. It seems to me very much a new regime, right? So, and we have no idea what the long-term effects of such market tampering is. And I think we're all learning about, what are the limits of the Fed balance sheet, basically. Maybe there are no limits, I don't know. But it seems to me that we're in the process of trying to figure that out. And so I think this is really a new regime. I also want to talk about, in terms of learning, we really don't understand well what drives movements in factor risk premiums, okay? So we've done the market a lot, but there's lots of factors that seem to be priced, right? But what is the reason the risk premium move? And I'll show you some evidence that, this is kind of, some of the movement is sort of very persistent, okay? This could be sort of time varying arbitrage capital, crowdedness. Is it that the actual risk went away? Is it that risk aversion went down? I don't know what's going on there. And so I'll give you some data on this, but I'll point out that this is also a measurement problem. What are the conditional Sharpe ratios to the factors? The conditional, that is something that I'll mention a paper that's doing this right now. And I think it's very interesting results, totally counterintuitive, totally inconsistent with our models. Okay, so I'll show you that. I won't have any data on this, but to me, this seems like competitiveness in certain industries have changed. You know, this tech, social media seems to be sort of very big firms having a lot to say about what's going on in the economy. I'm not sure everything. Are we maybe learning something about market power or brand value? And it seems to sort of, this is something that at least we haven't seen for a long time. Okay, and then, you know, there are many variables that are trending. And so I'm going to show you some plots of trending. So I'll just start with the trending. And so I wanted to show this to you. I think most people know the first things I'm going to show, but I want you to have seen it if you and sort of thought about it. It's kind of amazing. So let me start with the obvious one and sort of somewhat less interesting. People have been showing this graph for a long time. If you're thinking about looking at the recent data, one of the things that should, you know, pique your interest is just a pattern of the risk-free rate over the last 40 years, right? From 1980 till today, the nominal risk-free rate, short-term T-bill rate, and long-term rates too, has just gone down, kind of slowly, and it's just sort of asymptoting to something close to zero. And, you know, of course, part of that is just inflation, but the real rate has the same pattern. I'll show in a second. And it strikes me as kind of unlikely that this was that these type of dynamics were deemed possible even. One thing is expected, clearly not expected, but possible. Really, there should be a very low probability of getting to these type of states when viewed in the history. So I think that's something that sort of speaks to that. Just one of this, I don't know off the top of my head any of our structural models that predicts the same decline, in particular in the real rate. So let me show you this. It's kind of cool. So if you go to the Fed's webpage and you look at, you can Google, you know, long-run expectations or the natural rates, but you can go here, okay? New York Fed, they use this Laubach and Williams model to get the natural real rate. And that's a real interest rate that's sort of, you know, at full employment and at stable inflation, what's the real interest rate, right? And in many models, that's assumed to be a constant. Now, it doesn't really need to be a constant because you can imagine that the long-run growth rates have moved or that preferences, like time preferences have changed, et cetera. But in many models, it's a constant. So if you look at, this is real-time data, okay, for this model, look at from 61, this is a blue line, to 2019, the sort of the R star, the natural interest rate is just going real, this is not inflation, just going down for 40 years. And again, you know, this is a Fed, you can see how they're created, maybe, you know, but I don't know any models that sort of predict this type of thing. And so something is off in these models relative to, in many of our models relative to what at least this implies. And the long run real growth rate too is much lower, right? It's sort of gone down from 4% to sort of 2%. And so there's this very clearly we're learning something about the world. You know, maybe it's a new regime, maybe it's just but this seems to be that dynamics that are very hard to pin down in this sample. I mean, it's very persistent stuff. Similar, I want you to have seen this. A lot of people are aware of this. But if you look at the PE ratio, this is the PE10 ratio for S&P 500. The data is from Amit Goyal's webpage. So this is like the 10-year moving average for earnings and then the price. And if you look at that from 1880 till today, you sort of see this trend in the post-war period where it sort of seems like the world got better. You know, it could be that the real rate went down, but then the growth went down too. So yeah, maybe the real rate went down a little more. So maybe that's part of the story. But maybe also there's part of the story is just risk premium going down, or that somehow there's a separation between corporate profit and GDP. That's somehow more money is funneled to firms than it used to be. I don't know. I'm just pointing out that there's some big trends in the data that seem sort of, if you were to plot the price dividend ratio from most of our models, they would not show these type of trends, okay? They would not predict this. So I don't have the answers. I'm just pointing out these are things that our current models really don't get at. Here's a related one. So so the value factor, right? The value factor is well, you know it, HML. So high book to market minus low book to market firms, right? And it's sort of been like the dominant anomaly, I would say. And a classic paper, and I really like this paper, by the way. If you haven't seen it, read it. It's Liu Zhang. It's a job market paper, I believe. It's at the JF 2005. Super nice paper, sort of production-based asset pricing paper, explaining the value premium. Okay, in a rational model, or at least an exogenous pricing kernel. So maybe it's not rational, but at least the firms are rational when faced with a pricing kernel, I should say. So he explains it. But if you look at the value premium, and what I've plotted here is 15-year average return. So I have, I start in 63, I end today. So I have sort of at least 4 independent observations here. But these are 15-year average returns. They are overlapping. So there's a little bit more autocorrelation here than you don't let your eye trick you, but there are 4 different data points here. So it starts sort of at 7%. And sort of, it seems to be sort of just declining through the sample. In the last 15 years, the value premium has been minus 4% per year. This is, be precise, this is monthly average multiplied by 12, right? Okay, so now you're looking at the value premium and you just see, well, this thing has just sort of gone away. Or maybe it's just a string of sort of bad shocks and it's going to come back with vengeance, right? And in particular, in the dot-com boom the last couple of years, you see there was a tremendous downward return to value because all the growth firms, like now, all the growth firms were making huge profits, high valuations, and the value firms weren't really cutting it. And so maybe it's going to kind of slash back, right? And be like this hockey stick and we're all going to be happy again. But the thing I'm pointing out is that I don't know, and you don't know either. You don't know that, this thing is for sure going to come back, or it's gone. And so it seems to me like there's a lot of these things that we really don't have a clear idea. And so whether this is a sort of a nice constant value premium, or maybe it's gone away, right? And so again, this is something that seems to be we're learning about it. We're trying to figure it out. We don't fully understand it. And it seems to be interesting to try to understand. Maybe as people sort of learned that it wasn't really risky, it sort of went away, or I don't know what's going on. Okay. But so I wanted to show you that. I think it's interesting. But in terms of Zhang's paper, which is again very good, should we now, is that what happened there? Is that no, so what happened in that paper that made this go away? Right? You can ask that question. In order for it to go away, there's got to be, maybe there's no adjustment cost anymore. That sounds unlikely. Maybe the risk premium isn't time varying anymore. Time varying. That also sounds unlikely. So anyway, that seems to me to not be understood well in the literature. And there's lots of papers that explain the value premium, but it's not clear to me that you should anymore, right? So I would look into that. I don't have an answer. So again, about trends and new regimes, the Fed's asset purchasing seems to me to be pretty, non-stationary looking, and just kind of what are the limits is the question that. So this is just from the Fed. This is total balance sheet, the size of the balance sheet. So because we know a lot of that is due to these asset purchases. So the size of the balance sheet sort of started going up in the financial crisis. And then they went up in the COVID crisis, right? A tremendous amount. And I don't know if this number is big or small, but somehow it seems that the magnitude has just increased, and declined to 3.8 trillion, and then it's going to go up again. It seems like is there a limit to this? And what does it do to our markets? This is brand new in the history, right? This entire plot here. And so it seems like, we're trying to learn about what the interaction between these two are. And I know for a fact that investors are trying to figure this out, because when you talk to institutional investors, this is something that they sort of are just puzzled by, right? So I want to link that also to this graph. What I have here is industrial production. I could do the same with consumption. I just had more recent industrial production data. So here's our real industrial production from 2015 till August 1st, okay? And so what you see is that industrial production is sort of chugging along. It's pretty stable and everything's fine. And then COVID hits, okay? And so we all know that, of course, and then it fell, by 15% or so. And then it's come up a little bit, but not that much. But just this tremendous negative shock to the real economy, right? But then if you look at the S&P, this is the same time period. The S&P was sort of, the S&P goes up, and then there is a tremendous drop here. But then it's back to top levels again. It's back, and we know that sort of coincided maybe with some asset purchases here. I don't know what's going on, but this seems very, very counter to a standard macro model, right? A disaster model. Sort of the disaster happens, all risk premia go up, but it seems like the stock market just treats it like it didn't really happen. And so maybe it's because this is very, very transitory, and the stock market just kind of knows that we will be back on top again in a couple of months. Or maybe it's not. But this kind of disconnect here is, again, one of those things where you're asking, did the consumption-based model get the right conditional Sharpe ratios and everything at the right time, right? So I'm not sure whether you can conclude value premium goes away from 15 years of data. That's a great question, Chao Ying. If you take the model in the Zhang and you simulate, I presume there is some specific simulation of the shock that should get you the figure that you showed. Great question. That's a good question. I agree. There is probably a version of the shock that would get me that, of the model. But the question is, what's the probability of getting that from the model? And so I don't know. Maybe it's pretty high. What I can tell you is that with 15 years of data, the t-stat in difference between this observation and this observation is greater than 3, okay? When you test for a difference in mean. So at least I have statistical power to say the value premium is statistically smaller than it used to be, okay? From these points, but I think my point is not so much that I know it's gone away. I think the point is the data is, if you were learning about it, if you didn't know what the premium was and you were just trying to filter it, I think your filtering would tell you that you thought the premium now would be pretty low, right? If you're sure it's there, of course you wouldn't update. You would be like, this is just a negative sequence of shocks. My point is that if you're uncertain about it, then you might update that this premium is now not there, okay? So anyway, I think it's a good question. There is statistical difference. I'm not saying we can decisively reject a particular model, but maybe something did change that created this. Okay, so we have this asset purchases and this weird response here. So to me, this is like things that are happening that we don't really have a good sense of. Let me talk about the last thing I want to talk about. I think is really interesting. Okay, and I think is a big puzzle. And we can argue about whether it's measurement error or what's going on here, but recall from the law of one price. From the law of one price, you know that the maximal Sharpe ratio at time t of all assets in a market, let's think about the US stock market, okay? The maximal Sharpe ratio of US stocks is equal to the volatility of the pricing kernel divided by its mean. And this pricing kernel, since it's equal to, the pricing kernel has to be, sort of spanned by the assets, etc. But that's not really a major thing here. So just go with this. The volatility of the pricing kernel is related to the Sharpe ratio. The conditional mean should be very close to 1, right? Because the risk-free rate is just very close to 1, gross risk-free rate. So we could sort of think about the Sharpe ratio as the conditional volatility of the pricing kernel. Okay. So if we could measure the conditional maximal Sharpe ratio of all US stocks, right, we would get the conditional volatility of the pricing kernel. Now, all our models have specific implications for this time series, the conditional volatility of the pricing kernel through the sample. For instance, if you have a standard consumption-based model, you might think that this should be proportional to the volatility of consumption growth. Yeah? Okay. So we can ask the following question. When risk is high, or when the Sharpe ratio is high, is the measures of risk within the model high? Do they line up the way you think they should based on our standard models? For instance, is it the case that the Sharpe ratios are high in recessions and low in expansions? You know, that's very kind of macro business cycle thing. Or do we have something else going on? And of course, we have a measurement problem here because measuring the conditional Sharpe ratios of US stocks is a very complicated problem. But there's some recent work on this, which is really interesting. This is not Haddad, this is Haddad, sorry, there's a typo there. Haddad, Kozak, and Santos has a paper forthcoming in the RFS called Factor Timing. Okay, and what they're doing is they're taking sort of a bunch of anomalies, right? They're like 50 anomalies or so, or more. They're taking principal components. They're sort of saying, okay, we've got the market factor, and then I'm going to add 5 anomaly factors. And you have these principal components to sort of get the main stuff in our factor models, and they show that sort of works well. Then what they do is that they develop a way to time these factors, and they show that if you use the book to market spread within each anomaly, which are long short portfolios, like the book to market or long side, book to market or short side, use that to forecast the anomaly return. That works really well, also out of sample. Okay. You do that. You can also estimate, if you want to, the conditional variance of these factors. That's not as difficult. If they're principal components, they should be roughly uncorrelated. And so you just do a sort of a GARCH or something on each factor and you get the variance, conditional variance, okay? So since this factor model works well in explaining stocks, they create an implied SDF, which is the following. The pricing kernel, here's a risk-free rate is set to 1. That's not a big deal. The pricing kernel is the prices of risk, beta t, times the factor return, so 6 by 1 vector, minus the conditional expectation. And from no arbitrage, from using the conditional law of one price, we know that BT is the inverse variance covariance matrix of the factors times the expected conditional return of the factor. Okay, so that's the pricing kernel that's implied from the factor model, and this is the one they're using. Okay. So now you see something, we can very easily get the conditional volatility of the pricing kernel. It's just equal to the maximal Sharpe ratio you can get from these factors using this BT here. And so the max Sharpe ratio is just, and this is actually from mean variance math. Expected returns on the factor, variance covariance matrix inverse, expected returns on the factor. I should probably have a prime here. Sorry about that, prime here, transpose, okay? Transpose on the first one. So you can estimate that. So if you have good estimates of the variance and the expected return, you can estimate the maximal Sharpe ratio. So here's what I want to show you. And I can tell you this happens in a bunch of models, these factor models. So what you see here is the volatility or the variance here, but you know, the variance of the pricing kernel, SDF, is sort of super high in the 70s in the recessions. And then, but then you see what happens to it is that it is sometimes high in some recessions. It is very high in the dot-com boom, right? And then it drops like a stone in the dot-com bust. The financial crisis does not register as a major risk event when you look at these cross-sectional factors. Okay. Now, if you just look at the markets, which is the dashed line, the financial crisis does appear to be sort of a major event relative to the market otherwise. But these factors are not you know, at the same as in magnitude. So this conditional Sharpe ratio, if you take this seriously, you know, maybe they have measurement problems. It could be. It's a difficult measurement, but it's an interesting measurement exercise. If you take these factor models seriously and get this risk-return trade-off, it doesn't really look like what our standard models would predict. It doesn't really look like from the equity space that we have a super high price of risk here and low price of risk in the dot-com era, et cetera. And so, you know, this is an interesting kind of time series to think about, and maybe we need better measurement, or maybe we should rethink some more models, and maybe it has more to do with, you know, the cross-section has more to do with behavioral mistakes than risk. That's a question. So anyway, those are kind of, those are just some thoughts I had on things for the future. I don't know if there's any questions. All right. If there's no questions, then I will say thank you for listening. And you know, I don't have the answers here at the end, but I hope maybe some of these empirical facts stimulate you to think about how to model listings. So thank you.
Thanks a lot, Lars, for great lecture. I'll take it as well. I guess there's no more questions. So thanks again to everyone for participating. This has been an exciting week for Macro Finance Society, and please follow us on Facebook, Twitter, and our brand new YouTube channel, which is where this lecture will appear together with all the others, assuming Lars doesn't mind. Join the Macro Finance Society if you have not yet. Once, I guess, you have completed your PhD studies. And in the meantime, please do keep following us, and hope this will inspire your future research. Thanks again to all the presenters, and also to Nina and Itamar for helping me organize this great week of the Macro Finance Society Summer School. And thanks to all the Wharton PhD students who had volunteered to help out in the process. Also, we have Chuck here today. And on this happy note, we will conclude, and see you all hopefully next time in the real world, although the next macro finance workshop will still be virtual, hosted by Becker-Friedman Institute at the University of Chicago, and this coming fall, for those who are members of the society. Although again, we will probably either live stream or stream on YouTube for everyone to see. Thanks again, and we'll tune out at this point.
Thank you.